That's when we're, yeah, that's when we're like, hey, they won for 2 weeks. And they're like, we forget quickly. Yes, it's a total. Right, it's so much more.
Yeah, we're right by the end.
I'm 46, so I'm 5 and off. Okay. That'd be pretty cool if they changed the antenna colors. But out there was all orange too. Yeah. Good. It's been a couple years. I know it's been 3 years.
How's everybody doing today? Feeling good? Feeling good? Feeling great? Good afternoon, everyone, and welcome to the very first Tokenized New York City. We're here in the Times Center, a prestigious venue that's hosted some of the most influential names in finance, technology, and global markets. I'm talking about names like Barack Obama, Elon Musk, Oprah, Warren Buffett, and today, I'm Tom Murphy, Head of Communications for Securitize. It's fitting that we're here on St. Patrick's Day today because I think everybody in this room understands that to facilitate access to the pot of gold at the end of the rainbow, that's what tokenization can accomplish. We're talking about technology that restructures financial markets and changes the way the world interacts with their investments. Our hosts today are Wormhole and Securitize. Wormhole is fueling a multi-chain ecosystem building towards a future where every asset, institution, and application is connected on-chain. Wormhole is also the official interoperability partner for the Apollo Diversified Credit Securitize Fund, which was launched in January, and also the official interoperability partner for BlackRock's BUIDL Fund. Now, of course, Securitize is the leading tokenization platform, having tokenized funds with Apollo, KKR, Hamilton Lane, and of course, BlackRock. And what timing for this event today as we talk about BUIDL, the fund which just on Thursday recently crossed the $1 billion threshold to become the only tokenized treasury to reach that mark. BUIDL leads the way in under a year as the tokenized treasury market climbs to an all-time high of $4.6 billion, growing 20 times faster than stablecoins since November. And that's not to knock stablecoins, by the way. They're also at an all-time high. We're all in this room today because we all understand that $4.6 billion number for tokenized treasuries, the $1.2 billion number for BUIDL, and the overall RWA market cap of $18 billion is microscopic compared to the opportunity at hand. This is just the starting block. We have institutional leaders, blockchain innovators, and industry pioneers all here to snatch the baton and discuss how we race to drive real progress and adoption. Today's discussions we'll discuss some of the most pressing questions in the industry, right? Questions like, are stablecoins and yield coins competition or complementary? Where and when does DeFi fit into the picture? And maybe most puzzling for at least the comms professionals in the room, are we hyphenating on-chain or not? We're grateful for the support of all our sponsors here today, sponsors that you'll hear from. I'm talking about Solana, Ethena, Zero Hash, Borderless, RWA.XYZ, and Latham & Watkins. And we can't thank you enough for your commitment to help amplify this message and discuss how we build the infrastructure of tokenized finance. We also have extra gratitude today for ZK Sync for sponsoring and hosting our networking happy hour, which will come through after today's agenda, so make sure you stick around. We'd also like to thank our media representatives that are here today. We have people from Blockworks, The Block, Cointelegraph, and Token Relations. We're very grateful for your coverage day in and day out that pushes this market further and discusses and spreads the word about tokenization and real-world assets. Now, I'm not going to spend any time getting into predictions about how big tokenization can be. That really depends on which study that you want to cite, which really just discusses how many trillions of dollars in how many years. I'm also not going to show you any graphs, but just know that they're all up and to the right with seeming all-time highs every week. Today, we have an incredible lineup of experts from the biggest and best companies who will deliver those conversations about product and prognosis. A lineup that understands that this mix of forward-thinking technology, buy-in from Wall Street institutions, and supportive policies from Washington can accelerate real-world assets and make a real-world difference. Our first Tokenize event is here in New York City. And if you think about it, splitting up a pizza is kind of like the fractional ownership that we talk about when we discuss tokenization. Of course, a slice of pizza doesn't really have any yield, and I wouldn't really say they have any utility unless we're talking about heartburn. But what would it mean to tokenize New York City? To get into that, to lead things off today, we have Wormhole co-founders Robinson Berkey and Dan Reeser to discuss just that. Let's welcome them to the stage.
Hey everyone, thank you for joining us today. My name is Robinson Berkey. I'm one of the co-founders of the Wormhole Foundation.
And I'm Dan Reeser, also the co-founder of the Wormhole Foundation. Thanks everybody for coming. As Tom was saying, we've got a lot on the docket today, but we wanted to start off with a little bit of a foundation around just what tokenization even is, what Securitize is doing, what Wormhole's doing, and this will hopefully set you up for all the sessions later today that get a little bit more into the details of the tokenization space. To kick off, just for illustrative purposes, I wanted to see if anyone in the crowd has a guess as far as the dollar value of all tokenized assets located here in New York City. Any guesses? No guesses. Okay. 5 trillion. Okay, so by our estimates, it's roughly 50 trillion, and this includes real estate, stocks and bonds, public infrastructure, equities, and what have you. Lot of value, obviously. In real estate, there's the Flatiron building recently sold a couple years ago for about 160 million, not tokenized. This Andy Warhol also sold just a few years ago for 195 million. And then, of course, the financial assets that we'll be spending a majority of today's time on. 20 trillion roughly in equities located right here in New York City, 1.2 trillion in treasury bills, 10 trillion in bonds, 500 in private credit. As you can see, lots and lots of value to be tokenized on chain, and today we're going to explain to you kind of why that makes sense to do.
Tokenization, of course we have to add in a good meme here. But as Dan mentioned, one of the things we want to make sure and do is kind of go over what tokenization is to set you up for the rest of the day. And the idea is that you're really just taking a traditional asset. So as Dan mentioned, there's a lot of assets within New York City that have the potential at being tokenized. and making a digital representation of them and bringing them on a blockchain. Once you bring them on the blockchain, they can then be securely transferred more efficiently, faster, et cetera, and we'll get into a few more of those benefits here in the next few slides. So traditional assets today, why do we need tokenization? They currently lack digitization. They're more antiquated, a little less inefficient. We have limited market hours, so we're all probably familiar at this point that crypto is very much so a 24/7 market. Slow, cumbersome redemptions, and we'll get into a graph of what redemptions look like today within tokenization. Limited access to alternative assets. So I think a good example of this is private credit, for instance. You know, today you usually have to work with some sort of broker, have to meet certain minimums, have to, minimums when it comes to purchasing, et cetera. And with fractionalization and tokenization, you can have access to assets that you otherwise wouldn't be able to. This is what I would probably call the democratization of finance, for instance. And then fractional ownership, so being able to give more people the ability to invest in these types of assets. So Securitize, what is Securitize's role in this within tokenization? So thinking about Securitize and why asset managers are tokenizing, we have a few reasons. Number one is greater liquidity and more access to broader markets. Real-time settlement, so blockchains are near instant finality. You have potential use cases in decentralized finance. So when we think about decentralized finance, that DeFi in general has an abundant amount of use cases. There's programmability, there's composability, things are run on code, you're able to eliminate some middleman, and the list goes on. You have a reduction in human error a lot of times because those things are running on code, and then you have 24/7 markets as well. So when we think about who the audience is today that is tokenizing things, so we have majority today is asset managers or fund managers. They're doing this for a few reasons. Number one, there's enhanced tracking and transparency. So blockchains by nature are transparent ledgers, decentralized ledgers. There's instant redemption with things, stablecoins like USDC. You can move at very fast paces and with near instant settlement, and the market's obviously 24/7 as we've mentioned. You have on-chain security guarantees. You obviously have a little bit more of a trustless ecosystem as well. And then again, 24/7 markets. And we already have some large traditional finance firms in the space like BlackRock, Apollo, KKR, Hamilton Lane, and more that are doing this today through Securitize. And one thing I'll call out, which I think is interesting where we are in the space in the industry now, is that we kind of have moved from what I would say is like the 2021, 2022 era of pilots and proof of concepts and wow, this could be great, and wow, we could tokenize New York City, and these types of kind of like opining on these concepts to months ago when I was sent a Block Explorer link and seeing BlackRock's BUIDL money market fund being tokenized and actually sent between blockchains. So it's here now, and these funds are using it with Securitize. So who are some of the other audiences, I guess, besides fund managers? Digital asset investors. So you can think about these as like digital native crypto companies. So it could be foundations, for instance. So crypto protocols typically have foundations. Those foundations have treasuries, and they're looking to diversify. You have new access to money market funds, private credit we've talked a lot about. I really like the idea behind tokenizing private credit because it is, in essence, what democratizing finance is. It's almost like this gated investment opportunity that your average Joe off the street doesn't really have access to. You obviously, a lot of DeFi protocols are starting to integrate tokenized assets or RWAs. We're seeing that more and more. And then things like instant redemption and a unified investment platform.
And apologies for looking at the slides. They don't have the slides down here for us, and we haven't memorized the deck, so maybe they can fix that for us in a second. But I wanted to get into a little bit more detail here. We've talked very high level, but to walk you through the actual process that an actual fund based in New York City, a BlackRock BUIDL fund, and how they've taken treasury bills and getting investors into the on-chain fund, which is called BUIDL. I'm not going to go through every single box, but I'll just go quickly. Starting at the left, this is fully permissioned, so KYC compliant with all of BlackRock's processes. There's onboarding and screening and subscription done in partnership with Securitize. That account is then funded with USDC using Zero Hash or USD, and then the funds are received, and then the tokens are actually issued. So the BUIDL tokens are in the wallets of that investor, and then the investor is holding. And these are T-bills, so they're earning 4% or so these days. But the cool part with these on-chain funds is that there's a daily investor balance and a dividend calculation that's then sent back in token form to the holder. So as they're accruing interest, they're accruing more and more of these BUIDL tokens in their wallet. And then going to the orange box here, this is when the investor wants to actually redeem their BUIDL tokens back into dollars, whether that's fiat USD or into USDC stablecoins. So at the top, it's more the traditional process, so this will take more time. You're using banks, you have to wait multiple days for the wire to be issued to the investor. Or on the bottom, which if it was me, I would be using, secondary sale using Circle and USDC, and then it's a near instant transaction after that atomic swap from the BUIDL token into USDC. Now we'll talk a little bit about what Robinson and I spend all of our time on, which is Wormhole. We're working with all these different parties on what you can kind of think of as a digital asset network that's connecting all of these tokenized assets across all of the major blockchains. Why are people thinking multi-chain? On-chain, if you haven't heard the word, it's kind of like the Web3 version of online. So when we think of on-chain, we think of on all chains, not just on Ethereum or not just on Solana, for example. Because these asset managers, they want to grow their AUM. That's the number one goal all the time. And if you're launching a product, why would you launch just in one market instead of launching globally in this decentralized world across all the major blockchains where there's different users on different chains with different demands? The other thing around that is the investor preference. So there are some people, definitely on the user side, but also on the investor side, who prefer Avalanche, who prefer Solana, who prefer Base, Ethereum. So being able to meet your investors where they want to be is another benefit of being multi-chain. And then we're getting there in terms of DeFi. The fact that these assets are permissioned makes it a little bit more difficult to get a lot of adoption in the DeFi space now, but I think this is something that everyone in the room should start working on together to start getting more adoption of these tokenized assets in DeFi.
And I really want to go back to one of the things Dan said that's important is this idea of on-chain, meaning all chains, not one. And at a high level, I think about Securitize in a lot of ways as the gateway for any maybe traditional asset to come on chain. And then Wormhole is the way in which you would unify that liquidity across all that chains. And when you think about, for the digital, the crypto native audience here, we've kind of grown up in the industry, I guess you can say, just thinking about crypto as this very fragmented, these blockchains, different economic zones, and it in fact is that way in a lot of senses. But when you're talking to these, I guess, asset issuers and having these conversations, they want part of why you want to tokenize an asset on chain is actually tapping into a new market of users, a new market of liquidity. And if you're only beholden to one of those economic zones, you lose a lot of the value in actually maybe tokenizing, for instance. So where Wormhole, I think, comes into play is making that on-chain really mean just generally on-chain like you would think of something online and not gated to maybe any particular chain. But also, of course, to Dan's point, if you have a preference of being on a chain, you can do that as well, or you can move the asset to wherever that preference is. But when thinking about this kind of tech stack, if you will, so remember we have the gateway, which is kind of Securitize, and then we have the unified liquidity layer, which is Wormhole. You are trusting this technology, and you should keep some of these things, some certain things we're about to go through in mind. Number one is security is really important. I'd argue for institution security is probably the most important thing to consider when, with these assets going between chains. And we can get into, please find me after, I'm happy to talk your head off about security requirements and what Wormhole's done, but it's quite significant. And then built-in compliance, customization, obviously a lot of times that's handled via Securitize, but also via bridging front ends that are built on Wormhole. Specific burn and mint transfers, we like this in particular because it keeps the fungibility between chains consistent. It keeps the total supply of any given asset consistent between all the chains. You want a credible platform. So Wormhole in particular, we work with AMD, Google Cloud, Circle, and then also a lot of the blue chip DeFi protocols like Uniswap, like Lido, and MakerDAO. And then lastly, proven technology. Someone that's a technology that's done this, that's moving assets today and isn't promising about moving assets in the future. So we're very much so in the camp similar to Tom coming on here and telling you everything's up and to the right. As you can see with this graph, this is effectively assets being issued, or RWAs, or tokenized on-chain. We think everything will be tokenized, or will start to move in that direction. In 2024, the market cap of assets, of tokenized assets, was up 32%. As we think about, we talk about Tokenizing.NYC just as kind of a mental model. We use the number 50 trillion, and maybe we can also talk after this and argue if 50 trillion was too big or too small. But that's what I think the numbers we have is 0.036% is what we have tokenized on chain today versus just New York, right? So the TAM, the opportunity size, is huge. We're still very early in that regard. And then the last thing, I think Dan brought attention to this, but DeFi is one of those core reasons why tokenization is so exciting, right? Being able to use these more permissionless protocols, use these protocols that are more composable, that reduce the middlemen, that give you more yield, et cetera. That's something that we really have to continue to work on, because while we do have assets that are on chain today, while we do have proof and we have these block explorer links showing us that they're moving around and people are holding them on chain, we want to give them that next step. Like, what is the yield they can get from that? What else can they use it as collateral to borrow against, those types of things? And we're starting to see that, but I think 2025 we'll start to see a lot more of it.
So that's a wrap. Hopefully everyone learned something new around tokenization, what Securitize is up to, and why these assets are launching multi-chain. And I'm looking forward to today. All these speakers that are coming today are going to go deep into various of these subtopics within tokenization. So thanks again for everyone for your attention now, and then also for just being here today. We appreciate the time.
Thank you.
All right, how we feeling? Next up, we have a very special opportunity. We're going to get into in-depth today on the opportunity for RWAs and how they interact with DeFi. Our next tandem is the perfect pair of partners designed for institutional investors. Carlos Domingo, CEO and co-founder of Securitize, which has minted nearly $2 billion in RWAs, and Guy Young, founder of Ethena, which boasts about $6 billion in assets. Let's welcome the founders of the largest RWA issuer and the fastest growing DeFi protocol to see how they're powering on-chain finance together.
Hi, good afternoon, everybody. I'm Carlos Domingo. I'm the co-founder and CEO of Securitize.
I'm Guy Young, the founder of Ethena.
All right, so we are coming here together first to welcome you to the event that we co-organized with the friends from Wormhole, but also we wanted to take the opportunity here to introduce a very exciting project that we've been working together with the Ethena friends. So Ethena, first, just a quick intro from Guy.
Yeah, sure thing. So Ethena was formed around 2 years ago now, and we came out with our first core product around a year ago. In that time, grown to around $6 billion in assets, so that was one of the fastest growing dollar-denominated assets in crypto history. And the core product idea was essentially trying to create a dollar-adjacent asset which used derivatives to delta hedge crypto collateral, and that allows you to issue what we call a synthetic dollar. You can think about this as like a tokenized cash and carry that you can use in different formats as collateral in the same way that you do with stablecoins. And after that initial first product, we also came out with a second one called USD-TB, very similar to the normal stablecoins that you see in the market at the moment, and that was in partnership with Securitize. So that's grown to around 800 million in assets in the last few weeks. And in that period of time, we as Ethena have become the largest holder of Carlos's product. So some of the big ambitions that we have this year is really thinking about how do we take the existing product set that we have at the moment, which is very much focused on a DeFi and crypto native user base, and really open it up to see how we can deliver these products for institutional users and investors that live outside of crypto right now. So excited to sort of share the plans that we have with Securitize through this.
All right, quick intro from our company. I founded the company in November 2017 and launched in 2018 when RWAs were not even called RWA. That terminology didn't even exist. And it's been a kind of like a long journey for many, many years when this part of the space, tokenization and RWAs, et cetera, was not the popular thing. But the narrative has changed the last couple of years for a variety of reasons. I think first, institutions have really embraced the space. Companies like our customers like BlackRock, Apollo, Hamilton Lane, KKR, and some of the native crypto funds like Blockchain Capital, Parafy, et cetera, have embraced the tokenization concept, partly also because we as a company have done all the hard work in between of not only building the tech stack, but also getting all the necessary licenses and all the the regulations that we need to be able to serve these large TradFi companies coming into the crypto space. So actually, last week, we exceeded the total AUM of our products by $2 billion. We're more than twice larger than the second largest tokenization platform in the space. We have the largest asset in the industry, which is also the largest tokenized fund, which is BUILD, done in partnership with BlackRock, which is at $1.2 billion now. We have the largest tokenized equity project done with Exodus, which actually, I was talking to JP, their CEO, this morning, is already $290 million because their stock price went up. And this is a very interesting project because we manage a publicly traded equity as well as a tokenized equity simultaneously. And finally, we have the largest tokenized institutional fund with Blockchain Capital, which was one of the pioneers in the space. All right, so what do? So we basically sit in between issuers and investors. So issuers are people that have assets. We are not an asset manager ourselves, as opposed to many companies in the tokenization space. We are basically the bridge between professional asset managers that have interesting assets that they want to bring into the crypto system. I have a number of licenses and enablers like investment manager, transfer agent, fund services, et cetera. We launched in Q4 last year. And then we have a broker-dealer that allow us then to sell these tokenized assets down into the crypto ecosystem through a passport product called Securitize ID that has more than 500,000 accounts, and through a connectivity with the registered investor advisor markets, as well as with the ability to provide lending against these assets through the Securitized Credit product.
So Carlos and I were ideating on different ideas that we could sort of expand the relationship that we had built with the USDTB product, and sat together really thinking about what is it that blockchains are actually used for today, and actually have product market fit with the current user base within the market today. We came up with two simple answers. You really have speculation on one side of the market, which is the meme coin trading on Solana or the derivative trading on Hyperliquid. It's really swapping as the core function that you sort of find for the settlement on those blockchains. And then we saw a different category, which we think is important today, but is actually the one with a larger growth opportunity ahead of it, which is really the settlement for digital dollars, stablecoins, and tokenized assets going forward. The former, we think, is extremely competitive right now, and there's actually a really interesting design space for us to try and build something that's actually purpose-made to facilitate that second use case. So I think coming together with the two different brands and businesses, we're really sitting on the opposite end of the spectrum, where you have Ethena on one side with a DeFi native sort of background, crypto native assets that we're trying to export out into TradFi. And then you have Securitize, which has done an amazing job of bringing TradFi native assets into crypto to make them more useful. And really what we're trying to do here is bring together those two pieces to provide what we think is going to be a really interesting opportunity to facilitate those settlements of tokenized assets.
Good. So for anybody that knows me and has heard me talking about this space, I think there is a reason why tokenization and RWAs didn't take off a few years ago. And the main reason is that it was at the beginning perceived that as I take my securities and then I put them on a better ledger. So blockchains are better ledgers. They are ledgers at the end of the day. They are public distributed ledgers. They're cryptographically secure. They're definitely better than what people use in traditional finance. But just putting things on a better ledger doesn't make the asset necessarily better. This is more of an efficiency for the asset manager and other people. And what has been missing in the industry is how do you make these assets that are on a public blockchain and that they're tokenized a better asset that can actually do more things and has more utility than the same asset when it's just sitting on a centralized ledger, behind the ring fence of a bank, et cetera. If you think about where the utility comes in crypto, it comes primarily from DeFi, right? DeFi is what brought utility to digital assets. Is what allows you to do lending in a very simple way. Is what allows you to do swaps between assets. Is what allows you to do automated market making and all these utilities that have made digital assets grow. And at the same time, the DeFi ecosystem sits today at $100 billion. But if you look at how capital markets are, where all these other assets sit, it's $100 trillion, so there's a massive gap between the two spaces. And then what we're trying to do here is to basically take, traditional capital markets assets, put them on tokenized form, and then make them useful within the DeFi ecosystem. And that's not a simple thing to do, because DeFi was natively defined to be permissionless and anonymous, and to work with assets that are freely transferable to anybody, et cetera. So marrying these two worlds is actually a complicated thing. What our expertise is basically how to take TradFi assets and put them in the crypto ecosystem, and Ethena's expertise is how to make DeFi more useful. And then we decided that bringing those things together and in our own settlement layer was the way to actually make DeFi go from the $100 billion that is now to trillions of dollars, and make the $100 trillion of capital markets to move fully on chain. All right, so what we're announcing today is the following. We're going to launch a new chain together between Ethena and Securitize called Converge. This will be the place where RWAs and DeFi will converge into the same thing that will make grow both the RWA market and the DeFi markets to an order of magnitude bigger than that.
Yeah, and I think to just expand on Carlos's point, I think we also just had a look at really the growth of DeFi relative to the market in the last cycle during 2021. So today, assets that are sitting within DeFi are actually well below the peaks that you saw in 2021. That's with Bitcoin being almost twice the market cap that it sort of peaked at in 21, and then stablecoins more broadly adding more than $80 billion in that period of time. And I think the conclusion we came to was we really have no interest anymore in just shuffling the same chips between each other. I think a lot of the new applications, new chains, really we're just kind of moving money between the same boxes in different places, and not really thinking deeply about how do we deliver these products in a meaningful way to new pools of capital that are from outside the system. We also think that this is the biggest theme of this entire cycle, which is really ETFs coming to the market and real institutional flows coming through that vehicle into crypto. But we don't really have many more conduits through which real dollars flow in from the real world into the crypto system outside of these ETFs. And so really what we're trying to do here is take crypto native assets, package them up in a way which is compliant and TradFi can actually interact with, which we're going to expand on a bit later in terms of the applications that we're building on here. And then also finding a way to take TradFi native assets into this shared settlement layer, and then wrapping all of the great things that we have around DeFi, whether it's money markets, trading, settlement, and that sort of like increases beyond just the initial scope that Securitize has sort of launched their products with now. And I think that was one of the pieces that we got really excited about, was just hearing the ambition that Carlos and the team had in terms of expanding the different types of assets they want to bring on chain. And we really just want to be there as supportive partners to build the financial infrastructure around those assets.
Good. This project will not be possible only between Securitize and Ethena. I think this is an ecosystem that we're trying to form here. So both companies have worked the last few weeks to bring the best-in-breed partners for the launch of this new chain. So Guy, can you introduce oh, sorry. Forgot that there was another slide. So I think that we've already discussed this about how the two companies come together. So Ethena with their native DeFi assets, with one of the largest, fastest growing asset, and us with all the RWAs. So we're bringing this together, and it will be fully integrated in the chain. But as I mentioned, besides Ethena and Securitize, you also need a new set of partners that will come and make this a reality. So Guy, if you want to explain the first set of partners here.
Yeah, I think this is something that looks quite unique to what we're doing on the chain. So I think the world as it exists today, you have permissioned assets, which look like securities, some of the assets that Carlos is bringing to market. You have permissionless assets, which is Ethena's first core product, and most of the crypto assets that you see within DeFi right now. But you really have this problem where a lot of the financial applications where you can put permissionless or permissioned assets are totally non-KYC, totally open, and just not delivered in a format where TradFi can actually come in and interact with it in a meaningful way. And so really what you're going to have are three different buckets of applications that sit within the chain. You have fully permissionless DeFi, which is where Ethena sort of started and has a huge amount of critical mass from its existing deployments on ETH-L1. We're going to be bringing that critical mass to the chain on day one, so that you have the existing permissionless DeFi coexist really with this new layer of applications, which you can see on the screen today, where we're essentially taking the same sort of ideas and products which we know found product market fit, building around our assets, and then putting permissioning and KYC layers on top of them, so you can actually have TradFi interact with these protocols in interesting ways. So very obvious examples you got here with like money markets. At the moment, you see leverage where people are levering up or looping some of these assets within DeFi. What if you could start to plug in investment banks, retail banks on the lending side when they actually know who's on the other side of that leverage? And I think that's one key area here where both of our assets can actually fit in and sort of broaden the set of different participants that can come in. And then other examples you can see with Pendle, for example, was one of the huge success stories that you saw within DeFi in the last 2 years. One issue there is that when you don't know who's on the other side of a PT, which is the fixed rate product that Pendle produces, you can't really package these things up as fixed rate products to then export out into TradFi. So we're really just taking the concepts that we know work, that we know find product market fit already, and then putting them in a format that we can actually deliver it to new pools of capital.
So besides applications, you also need infrastructure partners because all our assets are institutional, and therefore we need institutional-grade tools to make a new ecosystem a reality. So besides the partners that Guy has mentioned, we have selected the following partners to support us on the launch of the new chain. On the Oracle side, we will be supported by Redstone and Pith. On the cross-chain interoperability, Layer 0, which has already been supported, Ethena, and Wormhole, which is our partner for expanding the assets across chains. So the assets that are in Converge will actually be able to move across other chains thanks to the Wormhole protocol. And then we also need institutional-grade custody and key management. So the key partners that have supported us in this endeavor so far and that are coming also into this new project are Anchorage Digital, Copper, Fireblocks, Komainu, and Zodia. So that's it. This is the announcement. There's already a long tweet thread where you can actually see more details. You can go to our website, conversionchain.xyz, so you can see the launch information. We are planning on launching this live in Q2 this year, so we've been working on this project for already quite a time. And then we'll be telling you more about the project every other week leading up to the actual launch. But if you want to know more, you can just go to Conversion or Chain or follow Conversion Chain in X. So thanks for coming. Thank you.
All right, well, next up we have a powerhouse panel that's going to explore how innovative financial vehicles are revolutionizing the internet economy. Moderated by Ben Weiss of Fortune, we'll have this discussion featuring Sandy Kulikov of Aave, Guy Young of Ethena, and Saeed Badreg of Wormhole Labs.
Hello. Fun to be here. I think the best way to kind of start off is I'll introduce myself, and then we'll kind of go down from Saeed. But my name is Ben Weiss. I'm a crypto reporter at Fortune Magazine. And yeah, we're here to talk about new financial vehicles. So Saeed, do you want to go?
Saeed, CEO of Wormhole Labs.
Guy, the founder of Ethena. Hello again.
Sandy Kulikov, founder of Aave, which Aave Labs is part of, and Aave is a decentralized financial protocol for lending and borrowing with 35 billion worth of market size today.
Cool. So I think the panel is titled New Financial Vehicles, and I think especially in crypto, a new financial vehicle is very much circumscribed for what's happening in politics and regulation. And especially now, we're having this conversation almost 60 days into Trump's new administration, especially following a couple of blockbuster announcements, including the Bitcoin reserve, et cetera. I think I kind of wanted to open it up and get everyone's take about how this new admin is either potentially accelerating or deaccelerating the expansion of crypto, the adoption of crypto, et cetera. So I don't know, Guy, why don't you go?
Yeah, sure. I think it was interesting in Q4 because I think we ascribed a lot of optimism in terms of what was going to happen, and I think people front running a little bit without sort of knowing exactly what the plans were. And I think we've obviously seen a bit of cooling off from that enthusiasm more recently, but I think...
Why is there cooling off, you think?
Well, I just think there was too much optimism baked into what was going to happen before without any real details sort of being shared. I think everyone knew that they were going to be supportive, but what that actually sort of translated to in reality was an open question. I think from our side, it's obviously extremely encouraging that they are engaging in so many different ways, especially with us building on-chain or within DeFi, sort of seeing some of the work or at least effort that they're putting into actually engaging with stuff like World Liberty, for example. I think it's quite crazy to me to even see a headline that like they know what DeFi even is, I think at that level. And yeah, I think all of the news that's coming out is extremely positive. It just takes a longer time than people want. I think within crypto we have short sort of time horizons and expectations for how quickly things
Price
get done.
go up,
Yeah,
happy.
and it's been nothing but positive headlines in terms of actually engaging. Yeah.
And I think especially because we have you and Stani here, like the question for DeFi is interesting from this administration because you haven't seen the necessarily actions from them, at least on the policy level, approaching kind of the DeFi question. But Stani, I'm curious, like, what your feelings on this, especially as somebody who's, one of the DeFi OGs, so to speak, in the ecosystem.
Yeah, I think obviously like the atmosphere is definitely going to a bit more better direction. And if you look at just a few years ago when we started to build Aave and one of the first primitives in DeFi started to actually emerge, it wasn't really kind of a great atmosphere to innovate. So deep down, a lot of builders in our space really think about this technology as really empowering because the access and equal opportunity it gives to all the users and the transparency it builds. In some ways, it's a new financial infrastructure that is just better, faster, stronger, and more efficient and transparent. So in the previous years, it's been pretty hard to build in a way that you have the confidence of actually governments backing the technology that you're building. Even in our kind of like a small DeFi communities, you could definitely understand that what we're building is the future and this is what people need. And I think we're now going towards the direction of like DeFi is acknowledged on governmental level, but of course it's still a little bit pushed aside because a lot of the regulation and focus is still more on the centralized side, centralized stablecoins and so forth.
And I think that's an interesting point. Maybe I'll kind of pull in Saeed on this, is that like, we are seeing in this current administration, this current kind of like policy atmosphere, perhaps some cracks appearing, in this kind of crypto political support mechanism, right? It's, before it was all anti-Gensler, but now Gensler's gone. Maybe we're seeing some kind of push and pull between the centralized exchanges and from DeFi. And I'm curious, Saeed, like, where do you see kind of a coalition of crypto, especially because you're an infrastructure guy, so you're literally a bridge, right? Like, do you see that coalition maybe breaking up in some ways?
I feel like crypto like has a good. Historically, like crypto disappoints the optimist and the pessimist, right? In different points in time, and
which one are you, optimist or pessimist?
I'm definitely an optimist, but if you ask the optimist, like this is the best time it's ever been to be in crypto, and if you had told me 10 years ago that the President of the United States is going to issue an executive order for a strategic Bitcoin reserve, I would have laughed at you, So like that's amazing. Even though the industry kind of reacts to it and being like, it's not amazing, right? But it actually is pretty amazing, and it opens up the kind of political avenue for Congress to act and solidify that as an act of Congress. That's what the industry is looking forward, and it's constantly always looking forward, right? The pessimist is like, this is crazy. I would have never expected crypto to become such a major part of the mainstream conversation about finance and global trade, and governments and leaders of governments are all strategizing. So I would like separate it between two different sectors, right? You've got the DeFi sector, and then you've got everything else, right? You want to call it centralized, you want to call it traditional, you want to call it government. Like if you separate between those two, like extremely optimistic on the centralized and that side of the house. everything is going in their favor. We're looking at the Genius Act for stablecoins. You've got every single institution in this city that's putting together a stablecoin strategy. Like nobody sees the numbers that are coming out of Tether and says, hey, I couldn't use another $4 or $5 billion worth of revenue every quarter. So there's clarity coming down the pipeline. There's actual legislation that you can read today. You've got an administration that's supportive for it.
But what about the DeFi side of things?
On the DeFi side, I mean, you have a lot of good movements that are happening within the regulatory agency environment, right? Like there's a lot of great things coming out of there. You don't have tangible legislation yet. You don't have clear guidelines. You've got Fit 21. A lot of people are excited about that. Maybe coming back to Congress. It failed the first time. They want to change it. They want to bring it back to Congress, see if they can get it passed. But Fit 21 largely sidesteps the DeFi question. But for a lot of the people that I talk to, they're excited about the broker-dealer rule being stricken down from the IRS. Like that was a huge attack on DeFi. That basically made it impossible to onshore any DeFi back into the United States. Them striking it down is a very clear sign that America wants to see this happen onshore. It wants to attract those entrepreneurs that have left. It wants to attract those billions of dollars that may have gone and been invested in foreign companies back in the United States. So there's a lot to get excited about. Even on the DeFi space, it's just not as tangible and not as clear.
I think, Guy, especially because I would position you more on the DeFi space, kind of, with your stablecoin, et cetera. It seems like most of your optimism, especially when you were talking, you were specifically talking about World Liberty Financial and kind of Trump's, the Trump organization actually, doing a DeFi project. Is that where more of your optimism comes, kind of from this implicit acknowledgement of DeFi rather than actually any tangible legislation that's coming out?
I think that's right. Just an acknowledgement, and I think it's just high signal when they're actually engaged to try and build something rather than sort of forget that it even exists. I think the real disconnect, though, in my mind, is actually between institutional investors or people who are coming to the space for the first time or starting to dip their toes in. You speak to those kind of people, and they're incredibly optimistic about where products are going, where the entire space is going. The real disconnect, to me, actually feels like native crypto people that you read about on Twitter. There's just a huge dislocation, I think, between their sentiment right now.
People angry on Twitter at Trump's crypto projects,
or even just prices down and that kind of stuff. And
Yeah.
just the conversations that we have with other teams who are building incredible products like these guys. I think within builders, there's just incredible optimism around the products that are actually being brought to market now, being real useful things, which I don't think was really the case many years ago. And then you speak to people who are coming into the space. It just takes a bit longer for them to actually engage in the way that we want to. And yeah, to me, that feels like the biggest disconnect, which is sort of outsiders coming in, being extremely optimistic, and some of the people who have been just sort of jaded and worn out for many years on Twitter right now. Yeah.
Gotcha. Stani, are you jaded?
Well,
you've been around for a long time, right? I mean, I guess specifically, going back to the Trump crypto ventures thing, do you kind of, Guy was talking a little bit about this divide, right? It's high signal for institutional investors, for larger companies to get into this realm, but also there's a backlash against it, whether it's from the crypto Twitterati, whether it's from kind of more mainstream financial people. Do you think that backlash is warranted?
Well, the way I see it, and I kind of agree with Guy in the sense, it is a positive sentiment. And when you look, for example, at the previous administration, there wasn't extremely excitement about crypto or blockchain as a technology. So I do think that these types of signals are, in some ways, bringing a lot of attention. And I think
But is it good attention?
Yeah, I mean, any attention is good because it really brings eyes into the topic, and then that creates an opportunity for everyone to form their opinion. And I think that's really what matters, in my opinion, because what, for example, what Liberty Finance is doing is probably just a really tiny piece of what is happening in DeFi, in overall in crypto space and what's being built. I actually even think about when I just trying to figure out and think about like the long-term horizon of our space. I even think that maybe at someday the native crypto assets are going to be smaller than, for example, stablecoins. So maybe a few years from now, stablecoins are going to increase the market capitalization of more crypto native assets, and then securities in tokenized forms will even be higher in market capitalization on chain compared to stablecoins and native crypto assets. So there's a lot of happening at the moment, but it's really there's some connectivity from government to the DeFi space, which I think is great. But also, it's just a completely.
Is that just connectivity, meaning having people in Trump's circle specifically interested in DeFi?
Yeah. I mean that interest is quite real, and the fact that it is there, it is net positive for.
And you have Eric Trump just like DMing you and saying like, "Yo, like I'm having like 10% yield." No, no comment.
10% is quite a lot. But I mean, this is the problem. I mean, like 10% will be fine, but even getting people around the world, we're talking about 8 billion people, and giving them even like 2%, like 4% yield is a big thing. So the thing about DeFi is that it doesn't just touch Americans. It touches like everyone across the globe, and DeFi is just a way of creating this kind of an environment of algorithms that anyone can consume, and building it in a way that it's resilient. The fact that, for example, Aave has been able to withstand over the years with all these kind of market movements and have functional liquidations and still exist there is a really fundamental statement at the same time when the centralized lenders are basically disappearing.
One thing I just want to ask you about, Saeed, is, Stani was saying basically all attention is good attention in some ways, right? With the Trump.
Well, not exactly all, but most of the attention.
Okay. Yeah. Generally, a lot of attention is good.
Yeah.
Right?
Yeah.
Do you subscribe to that, or do you think that like kind of because it goes both ways, right? There's the criticisms to what's happened in the past 60 days, and there's also the attention that it has kind of got. Also, we'll move on from politics after this question.
I don't know. I think it's more interesting to like think about like why is there attention, right? Like what's behind all the attention? And I think
is it just because you have a big name, like you have Trump, right? Launching a meme coin. That of course that's gonna grab attention.
Yeah, but why is Trump launching a meme coin? Like why wouldn't he do that in 2016?
I don't know. Like, do you know?
I think it's because the industry and the market, and there's been massive shifts and a lot of work that's gone in this industry to get it to a place where you can tap into extremely large markets, like mind share across the world. Like it's not even just the U.S. It's global, and I think. And anytime you do anything, you're going to have the negative attention. You're going to have the positive attention, right? But the fact that it's able to generate this much attention, I mean, and you see what Trump did, and you see other leaders doing the same thing poorly, but
Javier Milei.
yeah. So, but you see these things happening, and I think it's people are still figuring out like how do I take advantage of this technology? It's definitely a technology that is not just theory or like an academic white paper anymore. It's like if you utilize it in the right way, you can have a huge impact. You can transform your business. You can really change a lot of things that it's no longer abstract. It's real and it's happening today.
And I think kind of like jumping off that, right? Like it's no longer abstract. It's no longer something that's just a bunch of degens are doing by themselves, right? All three of you are kind of at this intersection of stablecoins and often fintechs, right? That are wanting to get into DeFi, that are wanting to get into this ecosystem because they're seeing the huge volumes, they're seeing the huge, was it Guy or was it Saeed that was saying if you get $4 to $5 billion, dollars?
Yeah,
Tether. Like, of course you want that. But the counter to that, right, is you have all these fintechs coming into crypto. Could it be taking the wind away and the momentum away? And they attention away from the people who've been building the ecosystem for a long time. And I think that's I don't know which one of you guys want to kind of take that question and run with it.
I think we just play in different pieces of the stack. So I think when DeFi was first forming and Stanley was there with some of the other OGs, it was like very much a consumer-facing piece where you're engaging with these food farms, these like ridiculously incentivized and often like unsustainable things in the beginning, which is fine. Sometimes you need like the speculation for like real things to come out on the other side. I think my view of where DeFi goes in the future is that it actually just becomes extremely boring relative to what we saw in the past, which is if we want this to actually get to the scale that all of us have sort of described for years, which is like trillions rather than like billions where it sits right now, DeFi has to sit as like more efficient back-end infrastructure to some of the front-end facing stuff that you're describing there. So I think, I think basic example here with our two products is when you have a fintech, whoever it is, can you actually, in the same way, I think Coinbase came out with something recently with another money market where the consumer's coming into a centralized front end, which can look and feel a bit like a fintech, and in the back end, you're sort of like tapping into DeFi with the efficiency, the yield, or whatever it is that you're trying to sort of gather from it. And all DeFi is doing is sort of providing a better product in the background where some sort of fintech or centralized business is sort of like overlaying that on the top. It's been a huge sort of shift for centralized exchanges in the space for many years to actually start doing that. And I think if we're talking the type of numbers that we're describing in an end state, I think DeFi is just more efficient infra in the background, which is boring for like the degens sitting on chain because you're saving a few basis points. It's not something where you're longing a coin to make 100x. And that's sort of maybe the divergent view of what it looks like in the future.
And I think at some point, actually, it's going to be really, it will be quite pointless to compete with DeFi because, especially when you have that initial liquidity and I see DeFi protocols as simply algorithms of how to utilize liquidity or certain type of behavior. And DeFi is basically an open-end environment where everyone can come and build algorithms. So obviously, Aave has built a few of these versions, and there's always newcomers and tweaking. And you see the same thing with AMMs, automated market makers, where basically you have a better exchange algorithm, for example. So it is going to be at some point very kind of like hard to create a competing, more centralized product, and when you have this efficient infrastructure.
Do you think fintechs will just start building their own DeFi protocols, their own, having their own kind of labs and foundations, et cetera, that would supplant kind of what you three are doing right now?
I would say it's going to be less efficient because building a really good algorithm is really hard. And then once you build it, it gets very quickly commoditized. So basically, what really matters is the distribution. So what I, for example, like about what Guy's team is building is that they're essentially creating a product and using a DeFi as a way to package a strategy and then make it easy to distribute. So at some point, we'll notice that the best single way to distribute yield or any kind of financial empowerment will be through DeFi because it's borderless and it's this efficient system, and it's gonna be harder to do that in a localized level. So fintechs actually will just basically plug into the system, build the experience and additional services, and then just offer these products that are built on these DeFi algorithms.
And are we? I mean, Said, you're kind of Wormhole's entire thing is you work with a lot of institutions, you work with Securitize, like. Is it weird to talk to like banks and say like, hey, like there's this cool yield you can get on this like weird algorithm right here? Like, talk to me a little bit about actually educating these kind of stuffy suits about the wild west of finance.
Well, they are definitely very interested to tap into DeFi, and they're looking for ways to do it compliantly. It's not an easy challenge. And I do agree with what Sonny is saying is that you do have for years, everyone knows that people want 24-hour trading, people want instant settlement, people want to kind of disintermediate this daisy chain of people between the asset issuer, the company that's producing the financial product and the end user. All of these things everyone agrees with, would love to see, but they would always say, it won't happen, it can't happen, regulations won't allow it, or there's too many incumbents in place. But everyone understands that there are a lot of benefits to this technology that make things cheaper, faster, and allow for better user experiences. And I do agree with Stani that.
But the technology has been around for more than a decade at this point. So I feel
it's
like
gotten to a pretty good point now that the fintechs can plug into it.
Yeah, so the technology is good. It's not just like, because maybe what I was getting at was that the regulatory atmosphere has made people much more willing to engage with it. But you also say
exactly.
it's a technological, like.
They have this great technology, like these great sets of technology that they can leverage. They don't because they think that it will hurt their existing businesses, right? It won't be compliant, or there's no regulatory framework or guidance or clarity on what they can and can't do. That exists today, and if things continue to progress, like they can start leveraging those things. And these are not just fintechs; these are also banks, asset managers, everyone else. Like, Biddle just hit $1 billion in AUM. A lot of people are thinking that BlackRock is going for the crypto market, or maybe they are, but that's not my thought process. Like, that's not what I guess they're doing, right? BlackRock, I heard a number today, was like 15 trillion in AUM.
Yeah, well,
crypto's 3 trillion. Like,
you're like 1 billion, and Biddle, like, wow, that's cool, but it's like just a drop in the pond.
Yeah,
right?
and that's if you're looking at it from like the perspective that BlackRock is trying to capture value or grow its AUM from the crypto market or from the existing crypto participants. I take an opposite view because I'm working on infrastructure and contributing to infrastructure, right? I think what they're doing is they're testing out what are the benefits of this technology? Can I actually run these systems at scale? And are they better than the legacy systems that I currently use to interact with that massive institutional base of clients? All those people who have handed them $15 trillion worth of assets to manage. That's the exciting part, for Securitize, for Wormhole, for all the people that are working on the infrastructure side, which is like, you can call it a stress test, you can call it a pilot, but it's real money. It's real money at scale, and and they're real financial products that have their analog counterpart in TradFi, and it's just scratching the surface, right? Of like how many of those things can get tokenized on chain, and they can start to make their businesses more efficient.
I mean, I think that kind of gets into, tokenization, right? This conference is named after tokenization. It's been kind of just like a word thrown about. I think in crypto, I don't know, probably since Ethereum or even earlier. But we really haven't. I mean, yeah, $1 billion is big, but it is a drop in the water. Like, I guess Guy and Stani, because you guys are more on the protocol side, probably like actually interfacing with these banks and fintechs. Is there actually a sea change in tokenization this year, or is it still a lot of hype and a lot of just kind of like, it's going to happen, it's going to happen?
Yeah, I think I think treasuries were like the natural starting point for this entire thing.
Yeah.
I think the difference in opinion I sometimes have with like all of these things are going to come on chain and there's like demand for all of these assets in crypto is that sometimes you're making the product a lot better, and sometimes you're making it a lot worse than it actually exists in TradFi. So adding like legal risk, sometimes there's like a Cayman Foundation here, which is actually like multiplying the risk rather than like thinking about how it's additive. I think the use of like a treasury is actually just the best example here, which is when you add it into different places where it can be useful as collateral, then you really start to unlock new use cases that don't really exist in TradFi right now. I think this use of Biddle was a great example, which is like strategically Securitize and the rest of the team were saying, are there different stablecoins that actually can integrate our product in the back end, and then they're useful as collateral to trade derivatives on exchanges, to put it down as collateral in the money market or whatever it is. And I think that that's kind of like the step that we need to take, which is how do you take these financial assets but put them into formats where they're actually fundamentally more useful in crypto than they were in the normal world. And that's, I think, the question for like these other assets that come after treasuries, because that was just a very clean, simple example that you can.
What do you think is next in terms of like, would it be stocks? Would it be mortgages? Would it be like, what do you think is next thing to be tokenized that's going to actually have, I wouldn't say like product market fit, because these again are like super small, but like would actually have adoption beyond just being experiments.
Yeah, I think there's a whole world of like fixed income that like exists beyond just treasuries, and people are always chasing yield in some format somewhere. So I think different pieces of like the fixed income capital structure, I can definitely imagine coming on chain and being able to sort of integrate those into different interesting places. I think the one I'm personally most excited about is potentially sort of the legalization of perps within the US. Specifically as it relates to equities. So I think everyone obviously knows that options are like the most popular way that like retail express leverage on equities at the moment on like a Robinhood. That to me doesn't really make sense, where you have perps, which I just think is like an outright better product for that type of use case. And I think the one piece, which I think is a huge idea for someone to go and build next cycle, is how do we take single name equities and attach like a perp to it, in the same way that that became sort of the killer financial product of crypto right now is sort of perp trading. I think that there's a huge opportunity there to try and build the same thing on equities. Yeah.
But I think bringing up perps and like leverage, I think is an interesting question vis-a-vis like DeFi, crypto infrastructure, and then dealing with banks and fintech, because you're talking about retail investors. So if you're introducing more risk and if you're introducing more leverage into this conversation, there's an interesting ethical question, right? Like, should we be doing that, even if there's appetite for it? And I guess like for you guys, like when you're interfacing with banks and fintechs, like I'm assuming they're thinking about these things and like thinking about these questions of like, should they even be offering these like products to people just because, even if they're illegally compliant? I don't know if Stani or Saeed have a kind of like way to go into that question. Or
yeah, I think banks are kind of like I think that obviously the tokenization is growing. Like it's happening, and it's actually nice to see that it's taking more traction now than before. And obviously the greatest example of tokenization is just stablecoins like USDC. They basically are a form of tokenization and quite widespread. I think when it comes to risk, I personally think one interesting idea is to use the idea of tokenization and provide access to investors or just users for things that weren't accessible before. So there's a lot of financial opportunities that basically aren't publicly traded, as an example, exist in private markets, and tokenization might be that tool of creating liquid
why is it a tool? Just because it's you don't have to go through like OTC desks to like get access to these things?
Yeah, for me it's weird that if you want to invest as of today, you have to write paper agreements. Yeah. Maybe I'm too on chain, but I think like we need to go from like this whole. I mean, we started as like finance, writing things on clayboards, and then we went into paper, and then we went into digital. Now we're going on chain, and with all these transformations, it just becomes more efficient, and with blockchain it becomes more accessible. So I think it will be very interesting if any person, any part of the world has the same opportunity to preserve their capital as any American, and then every American has the same ability to preserve capital than someone else, other part of the world. So like equalizing these opportunities with access, and I think that's where tokenization can be extremely powerful, but create opportunities that really don't exist at the moment.
So we have like 45 seconds. So Saeed, you said, oh, this might be a good question. So maybe we can end this way. What do you think the market is not pricing in? You wanted the question to be asked.
Yeah. In the short term, I think the market is not pricing in all the things that we're talking about here today, which is the clarity that's coming from the regulatory side that's pushing institutions, fintechs, big tech, everyone to have a crypto strategy and try to leverage the technology to benefit their businesses or better serve their users. And I think that maybe that's not reflected in crypto prices, but it's certainly not reflected in the stocks of the companies that are going to benefit the most by being very proactive here. So that's the short term. I think the long term,
5 seconds.
Long term, probably the market is not pricing in a Trump third term.
Oh, so okay, let's end on that. Okay, well, thank you everyone for listening to us speak. I guess we'll leave on that note. And yeah, hope you guys enjoy the next panel and talk.
Okay.
All right, coming up next, we're going to dive into the evolution of stablecoins, where they started, where they stand today, and where they're going. This next panel will have insights from Edward Woodford of Zero Hash, Gregory DePrisco of M0, and Nick Van Eck of Agora Finance. This will be moderated by Nikhil Suri from Wormhole.
Yeah, I'm moderating. So.
Do the little Queen's wave.
Ooh, it's quite comfortable, isn't it?
Not a
No, it's not. Ready to go?
Yeah.
Cool. Well, thanks for joining, everyone. It's exciting to see such a packed room. My name is Nikhil Suri. I lead product at the Wormhole Foundation, and I'll be moderating this panel today on stablecoins, past, present, and future. I'm joined here by 3 experts in the space, Greg, Ed, and Nick. And maybe if we could just start with a quick round of intros. Maybe who you are, a one-liner on what you're building, and I think you all came from the TradFi world, and so would love to learn how you got into crypto from TradFi.
I'll kick it off. So I'm Greg. I'm one of the co-founders of M0. We build branded stablecoins for other people. That's the easy way of putting it. The more complicated way of saying it is that we are stablecoin infrastructure that sits between issuers and distributors. My one-liner, so I'm the one who came up with the title for the panel. Don't know if you knew that. But yeah, I did come from TradFi just many years ago. So I was a commodity futures trader for some time, and then in 2016, I jumped full-time into crypto. So I'm here for a while now.
Great. I'm Edward. I'm the founder and CEO of Zero Hash. We provide stablecoin and crypto infrastructure to payment groups, including groups like Stripe and Shift4, to brokerage platforms like Interactive Brokers, and increasingly a bigger part of our business is providing tokenization payment rails to groups including Securitize, Republic, and Franklin Templeton. So we'll get more into what we do there.
I'm Nick. I'm the CEO of Agora. We offer stablecoins and stablecoin infrastructure, so white label stablecoins as well. I first got into the space in 2016 when I was working for a hedge fund, but spent my whole career as a technology investor, focused primarily on growth stage cloud software. And it was very obvious to me that all of financial services and payments were going to move on-chain in a very similar way to how cloud ate both on-prem software and a lot of human-driven workflows. And we're in inning number 1, and that was a bandwagon that I wanted to be on.
Awesome. Thank you. So we're at Digital Asset Summit. We're at Tokenize. I think one thing that a lot of people in our industry are thinking about and talking about is assets coming on chain, and beyond that, institutions coming on chain. And each of you is building a key part of this on-chain tokenized world. And so I'd love to hear from each of you on, what is the problem that you're solving that traditional finance has not solved, or even what is difficult for traditional finance to solve?
You want me to start?
Yeah, go for it.
So, I mean, what traditional finance has not solved is it's kind of our reason for existence. So, have you sent a wire transfer recently? Like, it's like going to the DMV. It's not a great experience. That's what the original stablecoins really solved. They were able to do international payments very efficiently. Like, if you're using USDC, it's so much better than having to go to JP Morgan and write into a form and stuff. But now, I think we're evolving into solving a whole new set of problems, which is how do we reorient money flows in the system without having to be intermediated by banks at every step of the way. And I think that's where we're really targeting. And what we're seeing is the evolution from these original stablecoin models, which are very monolithic, into a much more modular stack. So like we happen to sit right in the middle between the issuers and the distributors, but that still leaves a lot of room for other people to be the issuers and be the distributors and be all the supporting infrastructure like Wormhole, who we use for messaging and stuff.
So maybe I'll answer that question, why does stablecoins make sense? So we provide the rails in and out of tokenized assets for our partners. The reason we think it's really, really important, and we've done close to $1 billion on our tokenization payment rails in Q1, which is a massive portion of inbound flows into tokenized assets, is that effectively stablecoins allow for a critical unlock of tokenization to be realized, which is effectively a tokenized asset can be moved 24/7, 365. But the payment rails don't keep up, to your point around wires. So let's kind of take this a collateral example, if you hold a tokenized money market fund, the other side of that might need cash. If you can't liquidate and move the dollars, that creates issues. So increasingly, the way that we view the crypto and stablecoin landscape is that there's stable coins and then there's stable instruments. And the ability to move between all of them is incredibly important. So that's effectively what we do. We allow for somebody who has a stable coin to move into a stable instrument, such as a tokenized money market fund, and vice versa. And they each have their own benefits, right? So I think stable coins are more programmable. Hopefully, stable instruments will also become more programmable as well. But effectively, what we do is we solve two problems. One is a regulatory challenge and source of funds challenge. You can imagine the sort of diligence that it takes for a group like BlackRock to accept a stablecoin as a funding mechanism for a fund that they've issued. And so we work very closely with Securitize and BlackRock on that. And then the second piece of that is there's increasing abstraction, or there's increasing complexity that needs to be abstracted away. So there's two things I think are going to be true. One, there's only going to be more stable coins. And two, there's only going to be more chains on which those stable coins are built. We've just seen an announcement today for a chain, for example. And so if you are looking to leverage a stable coin in order to access tokenization assets, you want to abstract away that complexity. So that's effectively what we do, which we allow our partners to think in terms of account-to-account transfers, as opposed to thinking about all the chains and all the assets that underlie this and allow for an account-to-account transfer.
Yeah, and I just finish by saying, like, the demand for stablecoins is driven by the demand for dollars, right? And this is just a much better form of moving that money, right? You can move it 24/7, cross-border for very low costs. And I think where we've gotten, what's gotten us to 200 billion in stables today is primarily crypto trading and a little bit of EM dollar demand. I think over the next 20 to 30 years, you see stablecoins, at least US dollar stablecoins, getting to 15 to 20 trillion. So I think they eat the entire euro dollar market, right? Which is primarily EM demand and just G7, G20, ex-US demand for dollars. It's much better than the correspondent banking system where we were talking about wires. Like wires in the US is much better than cross-border wires where it can take 10 to 20 business days just to receive the money. And so there's real capital efficiency gains from using stables as well as cost savings. Beyond that, I think cross-border payments, FX, continued EM dollar demand, and then the institutionalization of finance on chain are going to be what sort of get us to 15 to 20 trillion from here. I think crypto trading is sort of close to tapped out.
Thanks. Yeah, I think a lot of points touched on, which we'll also revisit later in the discussion. But to focus on one right now is you work, I think, with a lot of major institutions, major financial institutions, so banks, asset managers, other kinds of asset issuers. These institutions have, for a while, talked about crypto and blockchains. There have been a lot of pilots. There still are a lot of pilots. From where you sit, from the conversations you've had, from your perspective, how serious are these institutions about actually coming on chain? What is stopping them from coming on chain? What will unlock them to actually come on chain?
Well, I think we have to better define which institutions we're talking about. Like what we've seen is asset managers love this tech. So they see this as a new distribution mechanism. It's a way of actually disintermediating the banks from what they do, so they like it. The banks don't like it very much because it takes away this kind of artificial monopoly that they've had for a very long time and causes deposit flight. So I don't think you're going to see commercial banks adopt this technology at large. They might keep saying they will, but yeah, I mean, they don't really stand to benefit from it because right now they're offering you a checking account or a savings account that's paying you 0% interest, and you can get a stable coin that'll probably find a way to pay you much more than that.
Yeah, I'd say there's a spectrum of risk, right? You sort of have prop trading firms, asset managers, and then banks. Banks are going to be the last to adopt this. I have a front seat at an asset manager because my family runs one. And I got into Bitcoin in 2016. They filed for the Bitcoin ETF in 2017. They were the first institutional firm to do so. It took 7 years, right, for that to finally get approved. If you'd asked me to bet all my money in 2017, how long it would take, I said within 3 years, bet all my money, I would have lost all my money, right? So part of the constraints aren't actually like their desire to move quickly. It's the regulators and the environment in which they're able to act, right? I think you're seeing pretty large change in tone from US regulators and the US federal government towards this asset class, which is great. And I think you'll see trading firms and asset managers to continue to move really quickly. But I think this is going to be a very long transition, right? Like, talk to friends who are leading some of these initiatives at some of the largest investment banks in the US. They're like, we're still getting through like crypto 101 and like how we even custody these assets. Is Fireblocks safe? What are the threat vectors if we use Fireblocks? And so I think there's a lot of folks that are trying to move aggressively. And you have some early movers. BlackRock is sort of testing the waters with BUIDL. But it's going to take a long time for the true financial system to come on chain. And I don't think much is going to change over the next 3 to 4 years there.
I would take a slightly different view. I think I think in the last, I would say, 6 to 8 weeks, I've been surprised by, I would say, the step function shift in banks. I think it's largely driven by the removal of SARB 121 with effectively a new accounting bulletin of SARB 122. That has fundamentally shifted their view. I think that the administration's view has also changed the approach. I think, at least from my experience and my view, most banks view the next 18 months as absolutely critical. They view that there's a window in time that they've never quite had before. But I think in terms of the question around the institutions around tokenization, I think you can't unbundle that from where is the value of tokenization, right? So I do think it's helpful to say there's this many assets in the world, and tokenization will eat some of that. But I think that misses the point. I think it's about, okay, which institutions face the biggest issues? And when I think you talk to institutions, they want a very quantifiable number in terms of cost improvements or other pieces. And that's why personally, where I'm most bullish is around tokenized collateral, because that is effectively a very clear cost of capital, right? You can basically say it's the SOFR rate with whatever your credit risk is. And that's very meaningful to people. It's very quantifiable. And so I think the ability to move assets 24/7, 365, I think for me, where I see the most adoption, or where I would like there to be the most adoption, is any entity, such as FX platforms that hold funds globally, but also, for example, clearing houses or clearing brokers, that the way that models work today is basically you build a chart and you say, okay, this is the risk, and we can't move money, so therefore we have to quantify that risk period. That is a weird way of thinking about the world when we now have mechanisms to move money 24/7, 365, including yield-bearing instruments. So for me, I think it's the institutions that face the largest cost of capital that will be unlocked.
Makes sense. And I want to dig more into what you were saying, Greg, about how you think banks might be the last to adopt this technology, how it's maybe competitive to their business. And Ed, you had a different take that you think banks might be coming in the next 18 months is a very, very important period for them. When you think about banks coming on chain or adopting crypto, how is that going to happen? Are they going to use it internally for settlement, or are they going to issue their own tokenized sort of deposits, which is an idea that people have talked about and been thrown around a lot recently? How are they actually going to adopt crypto? Are they going to use more permissionless protocols like M0 or Agora?
I'm going to pass the second half of your question on to them, because frankly, I just don't find the banks that interesting in this capacity. Like, it's competitive, though, to answer the first part of your question, because if you think of the two products, you have let's say they both pay 0% interest. So you're in a checking account paying 0%, you're in a stablecoin paying 0%. One is digitally native, it's able to move anywhere in the world instantaneously. It is better reserved, so it's reserved with only permissible assets under an MTL framework, probably. Whereas the bank deposit is backed by God knows what, can't move anywhere, and is stuck in your little bank's user interface that you probably can't even use. So it's just an objectively better product, and I'll be shocked as these things hit the market if you don't see capital flight out of the banks. But I'll let you guys answer the other half.
Yeah, I think banks are primarily going to use it for settlement. You may see tokenized bank deposits at some point. I don't really think those are as interesting as stablecoins for some of the reasons that Greg mentioned. But it's primarily going to be for cross-border settlement, and also just like internal settlement mechanisms within like their own subsidiaries.
Yeah, I mean, I'd agree. I think it depends on the banks, right? We homogenize banks as one thing. Citibank is different to JP Morgan in terms of where they make their money. So I think it's going to be, for me, again, going back to my prior point around cost of capital, global movement, There is a perverse incentive structure because holding large amounts of funds can also generate yield for the bank partner. But I do think that there's a disruptive element here as well, in the sense of, in effect, you can, if you issue a coin, you can earn interest in that for the perpetuity of its use case, as opposed to in the walled garden of a bank. So I think that's kind of what shifted in terms of banks' mindsets. But I do think it's going to be the largest FX banks in terms of the pain points that other folks have highlighted. But it's effectively the cost of capital point, and the way that moves, I think, is going to be the biggest area of adoption. I do think, though, let's just play this out, right? Let's say that Citi has a coin and JPM has a coin, and each of these coins are built on 10, 15 different blockchains, right? To Dan's point around on-chain means every chain. I think that's effectively how people are viewing the world now, right? We have to be on every chain. But effectively, how do you move that? Because you want JPM and I've got Citi, and I'm on ETH and you're on Sol. So I think the infrastructure pieces around abstracting away that complexity and effectively homogenizing something that's fundamentally not homogenized is really important.
The one other thing I will add is that banks will monetize this, particularly on the FX side, right? Because if you're someone like a Standard Chartered or like another large payment bank, like this is going to actually be very valuable to you in terms of like you're going to need stablecoin providers that are sitting with assets at these banks, so you can monetize that, but also like the on and off ramps as well, right? And so I think it'll be a really good enabler for a lot of these more cross-border focused banks.
Yeah. I think it's going to be the last mile, right? So I think, the Standard Chartered, the people that have the local rails off ramp. So if you actually play this out just visually, what are we talking about with stable coins or stable instruments moving globally? What we're effectively saying is that from one entity, for example, in Nigeria, you can move funds to the US dollar immediately with a USDC, or whether it be BIDL. However, this person in Nigeria still wants to receive their local currency, and this person in the US still wants to receive their local currency. So I think that local liquidity pools as well, and that's where DeFi plays a massive role, is effectively creating these global liquidity pools such that you can do the last mile. Because at the end of the day, a lot of people still do not want to receive a tokenized dollar or a tokenized money market fund, but they can be used as this abstracted away piece that has enormous value, but the customer experience is absolutely the same.
Got it, yeah. Shifting away from banks now, I think one thing that you've talked about, Nick, is stablecoins 3.0. Talked about the evolution of stablecoins from Tether to USDC to now protocols like Agora and M0. Can you maybe define a little bit more what you meant by stablecoins 3.0 and what the evolution of stablecoins has been?
Yeah, so very simply, Tether started 10 years ago. They were the original dollars on chain. This, sort of 2.0 was the iteration of this where you had like exchange-backed stables, which leveraged exchanges like Binance, Coinbase's distribution to start to build network effects. But there were many people that were cut out of this equation, primarily every other business, right? That were sitting on USDC, USDT, where they were effectively capturing or stealing the risk-free rate from all of these entities that were driving liquidity and utility to these assets. And so we started Agora with a simple premise of being a much better fiat coin partner to everyone else, right? And that sort of starts with economic sharing. There's a lot of other things on the infrastructure side that we're building to help do this. But whether you were a custodian, a chain ecosystem, a dApp, right? We're going to you and saying, hey, you can either use AUSD and we'll share the majority of the economics back to you that are on your platform, or you can brand us, right, and leverage your own sort of distribution and branding to retain a lot of the economic value derived from having stablecoin assets on your platform. And so I think the demand for that is insatiable. I think Craig would agree. That's a lot of the premise of M0 as well. Is like you have these two, this really duopoly cartel, right, that formed that cut everyone else from the economics, right? And in many ways, they weren't good partners to these businesses. And so there's a large amount of room for new entrants to come in and deliver a much better economic arrangement, but also product experience for the tens and hundreds of thousands of businesses that are going to come on chain.
Yeah, just to expand on that. So we like to think of ourselves as being in the business of complexity abstraction. So you see the people who want to issue stablecoins, they're generally the ones closest to the customer. They're not Circle, they're not Tether. Like Tether and Circle just happen to be really good at issuing stablecoins because they build liquidity and they have network effects. But they're not the ones that are actually distributing that stablecoin to the customer. And those people want to issue stablecoins, but they have too much complexity involved to do it in the old way. So what we do is we abstract all of that away from them into a single asset called M, which is kind of like a wholesale stablecoin. And then they can build around that their own feature set, their own compliance, and everything else that they need at the last mile to deliver. But we abstract all of the nonsense away from them. They don't have to worry about issuance. They don't have to worry about regulation. They don't have to worry about the yield collection, et cetera. We do all of that upstream on the other side of the protocol, so they never have to touch it.
Yeah, I mean, I think the yield discussion is an interesting one. I don't think that's the killer use case, right?
I would agree, by the way.
Yeah, I think like everyone look at their account, and you probably could be more efficient with how you sweep your funds into a money market account, right? Like we just, as humans, are a little, we don't really care about that little bit of interest. Yeah, we're lazy. And so I think the yield-based component, I think, really matters. You know, a lot of the conversation today has focused around effectively an alternative mechanism for transfer of value, right? That's effectively how you can think about the world, or you can think of it as a store of value. And I think yield-bearing instruments make a lot of sense in the store of value construct, which is potentially people like freelancers or people around the world. We, for example, just launched the payouts product with Stripe, and it's being used by groups like remote.com, and we've paid people in close to 50 different countries. When you look at those countries and you look at their FX rates, they're very volatile. So historically, they wouldn't mind, for example, Tether or USDC, because yes, they're giving up maybe 2-3%, but they're saving at 15-20% volatility in their currency. But I think that there's certainly an optimization around a yield-bearing component for that store value lane of the discussion.
Yeah, I think we also view, when people, ask us like, okay, well, we're looking for yield products, so we're like, well, we're not a yield product, right? If you want to buy a tokenized money market fund or Ethena or something else, like you should go do that, right? You should come to us for utility, liquidity, and Greg's point, abstracting away a lot of this complexity in the infrastructure, right? But if you want a yield product, you should go buy one, right? And I think people lump together stable coins, and we probably don't have enough time to define exactly what our own versions of a definition of a stable coin is. But to simplify it, I think about it as like the fixed income market, right? You can have something very simple that is like treasury backed, or you can have something that is way more exotic and you take on more risk, right? I wouldn't really define those products as stable coins. I'd view them as like dollarized assets. But yeah, it's like people ask, do you compete with Ethena? And I'm like, absolutely not, right? Like that's a great product, and like it's very different in the underlying structure. And so if you want something like that, you should buy it, right? But it's very different.
Yeah, and that's a good transition. I want to talk about, there's been this explosion of stablecoins or dollarized assets. There was this Twitter thread that was getting posted a couple weeks ago about USD Ledger or Ledger USD, how there's so many stablecoins. And so when you look at this world where so many stablecoins, is there massive liquidity fragmentation? How are you thinking about competing? And Greg, I think in one of your interviews I watched, you talk about there's the 100 million, hundreds of millions TVL mark, there's the billions of TVL mark, and then there's the juggernauts. How do you graduate into the next level?
Well, I mean, but I don't even think that framework will be useful going forward, unfortunately, because like what we're doing is we're giving that end distributor the ability to have their own branded USD. But I like how you pointed out how there's all these different symbols. I think that's going to go away. Like right now, it's almost like the .com era where everybody needs to slap .com on their corporate name, and that way they're part of the internet. So today, everybody's saying, I'm USD this, I'm blank USD, et cetera. That's all just going to collapse into USD. And because that's not the brand is not the important part, it's the control. It's who's managing the stablecoin, who controls how the yield flows in the ecosystem, who controls the compliance. Like to us, that's the much more relevant factor than what it's called. So I think you're going to see all of these tickers go away, and everyone's just going to call it USD. The tickers might exist for the back-end liquidity that we have to manage and say, all right, how do we transfer this one to this one to this one? But the end user will not be exposed to those tickers for very long.
I do think, though, that stablecoins are not homogenous and they're not born equal as well, right? And so I do think it's pertinent to point out that there is credit risk with the issuer, right? And we live in a world that, I remember it was St. Patrick's Day 3 years ago that there was a depeg of USDC. And so I think the onus, putting this construct of an onus on the customer to understand credit risk or differences or nuances. I think it goes back again. What is the problem that we're trying to solve? And for me, it's about programmability of transfer. It's about speed and low cost. And I think if you think about what happens in fragmentation, it drives up costs, right? We aren't going to cross USDC to USDT or infinite A to Z of USD for free. You're not going to bridge them across different chains for free, right? There's a very, very small economic cost there, but it aggregates if you think about the transfers if there's this fragmentation. So I think we have to be careful about fragmentation is good. It can create choice, but frankly, are the customers even aware of the choice that they're making? And then secondly, what does that do in terms of actually undermine the fundamental premise of tokenization, which is it was instant, easy, and low cost? I do think that we may be taking a step backwards, and there's groups like Wormhole and others that hopefully will continue to abstract this away, but we are making a very, very complex mache right now, and they are not equal pieces, for sure.
Can I just clarify one thing? So I'm speaking about this from the M0 point of view, where what our protocol does is it homogenizes the collateralization. So every stablecoin we issue is entirely fungible with every other stablecoin. I agree in that sense, like we can't fragment across issuers.
Yeah, I think you have a power law, right? You probably have 10 to 15 issuers that really matter, and then you have like a bunch of niche assets, right? And some liquidity is going to matter, and others it won't, right? It's like if you're a siloed network, right, and you're offering $1 asset to your customers, like does interop matter? Maybe not, right? Does liquidity matter? Maybe not, right? But I actually like Greg's analogy to like the .com era. I do think a lot of the tickers go away, and then the only people that really need to know are like the devs or like people that are doing the credit underwriting.
And so when you think about this fragmentation, how do you solve this fragmentation? Is it just something that we're always going to deal with? Maybe everyone builds on top of M0. How do you solve this fragmentation?
So I think M0 and us actually have the similar approach. You have a lot of these, say, longer in the tooth issuers that have been around for a long time, like Paxos, that have decided, okay, every time we issue a new stablecoin, we're going to create a siloed network of liquidity and utility. I think that's a mistake. I think the M0 team and us are taking the same approach where you want to have one asset that you build a monetary network on top of, and that's where a lot of the value accrues. And so I think that's one way where it's saying, okay, we'll go out to a consumer wallet or a perpdex or an exchange or a custodian, and they're saying, okay, we're going to launch, XUSD now for our customers, and it's all built on the USD network, right, or the M network, right? And I think that's how you reduce some of this. Then it's also just like having more competition amongst issuers, right? Tether is very expensive to off-ramp. USDC and Circle have been driving their costs up as well. Like we offer 0 fee redemption to fiat, right? So like that should bring costs down for consumers and for enterprises. So I think some of it's done at the issuer level, some of it's doing it at like the product level, and then working hand in hand with some of these guys.
Yeah, I could just say like, I know how it shouldn't end up, and I really hope it doesn't, which is how the commercial banking sector looks today. Like, we basically have the same problem these commercial banks had 100 years ago when they were all issuing different non-fungible deposits. Even though maybe they had similar composition, they couldn't be traded interoperably. So we had to make the Fed on top, and now we have this fungibility enforcer that's enforcing thousands of different assets where I just think, if we rebuild that system, why did we even do this? So yeah, I would hope that we take an approach like what myself or Nick are trying to do here, where we end up getting the interoperability at the collateral layer, not downstream at some sort of enforcement level.
Yeah, by the way, USDC's done this a little bit by accident, right? Like DAI backing themselves with USDC is like just sort of doing what Greg and I are talking about.
Yeah, I do think it's obviously we abstract away the complexity so that BlackRock doesn't need to think about, hey, we need to buy a tiny bit of Ethereum in order to be able to accept a USDC.ETH, and then I don't need to think about, and let's just, a lot of institutions still do not want to actually touch stable instruments or stable coins. And so effectively what the provider receives, and Dan's diagram showed it, the issuer actually receives dollars. So we abstract away that group. We're effectively an FX provider from USDC into USD. And we abstract away that complexity across, say, 15 different chains as well. I do think, though, that institutions do not view stablecoins as one and the same. And so although we offer many stablecoins, including PYUSD, RLUSD, USDT, USDC, DAI, and others, many institutions will narrow and say we only want to support X, Y, Z by their own determination of what they think is important for an issuer.
Great. OK, we have 30 seconds left. I want to do a really quick lightning round of questions. I have a couple. So there's been this recent, obviously, administration change in the US. A lot of people are talking about regulation that they want to see come out of the administration over the next 4 years. Real quick, what is a piece of regulation you'd love to see come out of this new administration over the next 4 years?
I want to see the Genius Act pass. I think it's actually a good bill, and I love that it puts encoded bankruptcy protections for consumers into the bill.
Yeah, I mean, I'd say the same thing for this conversation. I mean, I think the Stable or Genius Act, when you look at them side by side, they're largely the same. I do think that one has a more, I think the Genius Act, I think, effectively gives more preemption to the federal government as opposed to the states. So I'm more partial to that there should be competition between both federal and state. But I think that some combination of those two acts is a good thing.
Yeah, I agree, but maybe to add something else, I'd love for there to be a framework for some of these tokens to actually accrue value and drive it back to the users. And so maybe a refresh of some of the security laws.
Last question, lightning question. Can you name one financial institution that's embracing crypto in a way that really excites you?
No.
That's unfortunate.
Yeah, look, I would go for Tasty Trade. They launched, they're one of the largest brokerage firms in the US. They launched crypto with us in 2020. They'll be launching stablecoin funding mechanisms. They've launched a crypto wallet. And so I think there you have a multi-billion-dollar firm that is owned by a publicly traded company pushing the boundaries very early on. And I think it's, you need people to go out first, and then other people will follow. And I think that's the group that has certainly done so. And we've seen them be a reference point for other customers.
Yeah, I think it's mainly the asset managers and the brokerages. So I think Fidelity, Franklin Templeton, Van Eck, they're all doing really interesting things.
Awesome. Well, thank you so much. Enjoyed the conversation.
All right, folks, next up, this is our last session before we take a break for lunch and coffee and, of course, networking. So next up, we're going to explore the growing venture capital opportunities in real-world asset tokenization. And so this is going to be where innovation meets investment. And for this next panel, we have insights from Meltem Demirors of Crucible, Alpin Sheth of Borderless Capital, and Ben Foreman from Parify in a discussion moderated by Vicky Wang of The Wall Street Journal.
Hi, everyone. Thank you for coming to our panel. I think it might be good for us to maybe start with a little bit of self-introduction, what your firm does, and how your firm is involved in tokenization.
OK, I'll start. Meltem Demirors, my firm is called Crucible Capital. I've been in crypto 10 years, DCG CoinShares, now building this firm Crucible. Our focus is the energy to compute value chain. Energy, compute, crypto belong together. I think these are the three biggest trillion-dollar investment themes of the next decade, so that's what we're focused on. I'm going to be controversial and say tokenization, RWAs, unsure how relevant they are. I'm very excited about perpification and synthetics, synthetic derivatives. So yeah, that's us.
Ben Foreman, a founder of Parify. We're a multi-strategy investment firm focused on the blockchain ecosystem. We have venture and hedge fund strategies focused on different liquidity spectrums and different risk returns in the ecosystem. I spent 10 years in traditional finance at KKR and TPG before starting Parify in 2017. And our focus is really on this intersection of traditional finance, and blockchain. So things like DeFi, stablecoins, tokenization are all very core to what we do.
Hi, everyone. I'm Alpen. I'm one of the lead partners at Borderless Capital. We typically would put most of our investments in the cryptocurrency blockchain sector. We're big proponents of this category of tokenization. I think RWAs is a little bit of a amorphous category, but I think that we've been very bullish about this concept since inception, so almost I think 7 years when we first invested in Securitize. And I think that at this point, we're I think getting to see some significant interest and traction in the space. Beyond venture investment, we also do liquid investments, and excited to talk about that.
Yeah, so I think tokenization is a pretty well-known concept in crypto, but in mainstream finance, it's still sort of thought of as a small niche. Can you maybe break down, what are some of the opportunities in tokenization today?
Sure. Yeah, I could just start off. So I think the way we think about tokenization is it's kind of almost like a gut renovation of some of the key market infrastructure. One of the biggest problems that we've seen, even though this is one of the earlier themes that a lot of institutions and VCs were interested in almost 6, 7 years ago, is that coordinating across so many different actors is a major challenge. So there hasn't been clear standards and formats for people to actually interact, such diverse set of actors. And that has taken quite a bit of time to play out. I think that we're starting to see that around certain assets, for example, stablecoins. And I think there's a lot of reasons for why that is, one of which is we have such volatile interest rate environments. We have exogenous factors in the market related to policymaking where we didn't have any clear rules or regulations around these asset classes. Now we're getting to see some more clarity and interest in that. And I think that we're now getting to a point where tokenization has like a technical set of standards. And now we're increasingly seeing an intersection in terms of a regulatory set of standards. And I think that that's really important for this space.
I'll break it down really simply. So I started my career as a trader. I traded commodities. Today, when you trade different assets, you have different screens, right? So if I trade commodities, I'm trading on like ICE. If I'm trading equities, I have a different screen for that. If I trade crypto, I have a different screen. To me, it's been really simple when it comes to investing. My vision, my dream, I want to trade everything on one screen, right? And I want to be able to take that trade life cycle. So when you're trading, right, you have your trade execution. Then once you execute a trade, you can margin. You can use assets you have as collateral to back the trade and hold the position. Today, collateral is very illiquid, especially in crypto, but you need collateral on all of these different venues. So I think what's really cool and really exciting is actually fundamental innovation, market microstructure, as Alpen said. But the dream here isn't like tokenizing things, and I think people get carried away with this idea that somehow if we make something into a token, then it changes distribution. Forget about that. Focus on market microstructure and the ability to cross-margin trade on one screen. That, to me, is the really exciting part, is all of a sudden I can take one asset. Let's say I have exposure to an Ares credit fund. If it's tokenized and on-chain, I can use that position as collateral against another position, right? Because what I care about as a trader is my ROCE, is my ability to generate returns, and I want as much leverage as possible. So to me, tokenization is just another way of saying, let's amp up the leverage. That's how capital markets work. So I think it's really important in crypto. A lot of times when we talk about tokenization, it's like we want to democratize access. Retail should not be buying most of these products. It's not about democratizing shit. This is about increasing leverage and liquidity in the system through this innovation in market microstructure. So that's my fundamental premise. That's always sort of been the inspiration. And I just think a lot of the narrative around tokenization is nonsensical because we're creating even more screens, right? I'm going to trade tokenized equity on this platform. I'm going to trade tokenized real estate here. I'm going to one screen. We need everything on one screen, and we need to be able to get leverage, more leverage out of existing assets that are sort of trapped capital. That's what's exciting to me. I think there's a lot happening in that space that Also highly skeptical of a lot of what's happening in sort of the broader tokenization space because it doesn't make sense. I think it's important to talk about that as well. And I want to disagree with you guys. We all know each other. We agree on a lot of things. So I think it's fun to talk about maybe the things we disagree on.
Yeah, so I think at its core, you can describe tokenization in one word, which is formatting. You're effectively taking an asset that may exist in a legal agreement or may be held with DTCC, and you're putting it in the file format of a token. And formatting really matters for assets because it makes them easier to move, it makes them interoperable, and in the case of blockchains, this allows you to have atomic settlement, so you eliminate all kind of the back office, legal, compliance, operational costs that banks engage in, and you can hold assets sovereignly yourself if you choose to. You don't have to hold them through brokerages or custodians or intermediaries. And then on top of that, you can actually program in logic directly into these assets. Instead of having kind of dumb contracts like legal agreements, you can have smart contracts and embed if-then statements so these assets can actually move and perform logic tied to the real world on chain. And so, look, I think at the end of the day, what have we built, right, in this ecosystem? We built amazing pipes to move assets around. That's what DeFi is. But DeFi today, the water moving through those pipes are like, governance tokens or ETH. They're not really relevant to, traditional finance. I think the opportunity set is to take the $600 trillion of assets, stocks, bonds, currencies, and commodities, and move them into these next generation pipes and benefit from all these advantages. And to the earlier point, people have been talking about tokenization forever. Like back in 2017, people were saying, hey, we should tokenize this apartment building in Queens and make it more liquid. And I agree with Meltem, like, just because you tokenize something does not make it more liquid. You still need buyers or sellers. But what's different today is I think you have two things that you've never had in the past. One, you have significant institutional interest in this theme. So you have organizations like BlackRock that are fully behind tokenization. The second thing that you have is a much more clear regulatory environment, and that's just changed. And I think those two things have never existed in the evolution of this asset class up until today, and I think that's why that's the why now for tokenization.
Yeah, and speaking of BlackRock, their BUIDL money market fund on-chain recently surpassed $1 billion in assets under management, and that has really sort of illustrated this case for tokenized treasuries, tokenized money market funds. I'm curious, like, what do you think of sort of the sector-specific opportunities within tokenization? We've seen more private equity firms putting their credit funds on-chain.
Can we just double click maybe on stable coins and these treasury/money market funds? So if we just run the numbers, okay, there's $97 billion of treasuries backing Tether, okay? Cantor probably gets paid 20 basis points on that. So Cantor's probably clipping $200 million a year in fees just to custody money market funds for Tether. Circle, $50 billion, so same math, that's about $100 million in fees. So $300 million in fees going to banks just to hold money market funds so we can tokenize them. If we look at BUIDL, right, $1 billion, assume 20 bips to BlackRock. So I think if you're TradFi, obviously you love tokenization because crypto people are paying you 20 bips to hold money market funds. That's a great business. I would be in that business all day, every day. You're literally just printing money. My question is, what I think is interesting is how do we reverse the flows? So instead of taking money and liquidity out of crypto and parking it in managed accounts at TradFi institutions, how do we enable crypto institutions to benefit from flows going the other direction? And that's why I think this whole category of infrastructure finance, private credits, and these other categories where there's actually yield, like a coupon attached to these assets, starts to become more interesting. Because instead of just having someone capturing the net interest margin and banks getting paid massive fees to enable this interoperability you're talking about, right? Because there's a fundamental incompatibility between some of these assets and blockchains. So these institutions on the back end, really what they're doing is they're enabling the interoperability, right, by providing that one-to-one attestation, but you're still dependent on a SIFI, a systemically important financial institution. So I think there's still some fundamental work that needs to be done to think about how instead of taking liquidity and money out of crypto, giving it to financial institutions to allow us to mint stable coins, but the money is at the financial institution. It's not on chain. You get a coupon that's an IOU. The question I'm really excited about is how do we reverse the flows and how do we find ways to do this without just taking a ton of liquidity, billions of dollars of liquidity out of crypto and putting it back into the banking system? Because that feels a little bit counterproductive to me. I don't know if you guys have
Yeah, I mean, I think the main issue here, again, is like around, you know, if we think about tokenization and blockchains as being standards and formats, I mean, nobody is going to adopt them at scale until there's like some kind of, from my perspective, an exogenous catalyst. And I think that that's what we've seen. There's no real momentum shift to trust an entirely new set of standards and set of institutions to move money on chain in a real, at scale and reliably and securely until more recently. And it's only really happened with, you know, stable coins, with dollars that are custodied somewhere else, where you're basically having like a synthetic or some kind of representation on chain. For this to all happen more natively, I mean, I think it takes time, obviously, but I think that's where we're going, right? Where once you trust this format and this standard and this infrastructure and the stack, then it enables you to start issuing natively different kinds of assets. So when we backed Securitize, honestly, it's been 7 years of hoping and watching, you know, the builders, you know, in particular Carlos, really making the case over and over and over again. It was not easy, right? And what we're seeing with Wormhole is taking these opportunities and looking at, you know, the other side of it, which is you can build a platform, and now, as a VC, you see, you know, a plethora of these platforms and L1s and different kinds of structures there. There's a bit of oversupply on the infrastructure side. Then the question is, how do you make sure the liquidity is not all fragmented, as you were saying, right? Which is the biggest problem that we end up seeing as VCs in this particular industry is what I consider the underside of rapid innovation in crypto, which is just heavy, heavy fragmentation across the board. A lot of redundancy. So for us, bets like Wormhole are bets that's going to end, right? We're not going to end up wanting to see the same exact applications on every single chain. We want to see more aggregation and interoperability. And I think the convergence of those things, as represented in some of our portfolio companies, which we're really proud of and excited about, we're starting to see that shift over. So while I agree that, you know, tokenization or the concept of RWA is a bit amorphous and kind of ambiguous as to what is actually going to get traction there, I think that if we think about it in terms of standards, in terms of new market infrastructure, that's where we're starting to see it make sense, I guess, after like 7 years.
Yeah, I think like the other interesting framing that like I look at this from is there are like the fat tail of assets like dollars and treasuries, and like that's where a lot of energy is going. But there's also the really long tail of more esoteric assets that are too small in size for Wall Street to support, but have real kind of like interest and demand. So one example is you're seeing a lot in like the tokenized collectible space. We have a company in our portfolio that's tokenizing Pokemon cards, and it's doing about $500 million of GMV annualized and 40 million of EBITDA. People sending Pokemon cards, they're vaulted in Salt Lake City. They can auction them on chain. They can exchange them easily. The cards are graded. They don't want to custody them themselves, but they want to kind of effectively outsource that and hold them as collectibles, as an asset class. They can borrow against these cards. So the idea is you can take assets that don't have the same prime services as stocks, bonds, like the very fat tail of the asset curve, but get benefits, get the benefits of blockchains, which is, you know, fast settlement, composability, atomicity in settlement, et cetera. So, but I also agree with you, Meltem, that like most tokenization today are just IOUs. Like if you have a USDC stablecoin, ultimately trust traces back to a bank. Whereas like what the real goal here is to have the blockchain be the canonical ledger of record and to disrupt like what transfer agents or what D2CC does today. But I just think it's going to take time to get there.
Yeah. So how do you go about solving these problems of fragmentation and the redundancy in the tokenization space?
I think there's different approaches. Obviously, I think at the protocol level, there's a lot of people working on interoperability. I think interoperability suffers from the exact challenge that Ben just articulated, which is a lot of interoperability solutions still require trust in a group of counterparties who are running validators or managing a multi-sig, right? Typically, like interoperability solutions have been fraught with some of these challenges around centralization. So that's kind of at the protocol level and the network level. I think at the application level, one of the things we're starting to see is, companies typically pursue this land and expand strategy where like maybe your company that's in collectibles starts with Pokemon cards and then it's watches and shoes and who knows what else, and you kind of expand out from there. We're seeing this now. We've seen a lot of platforms focused on renewable financing, infrastructure financing. AI-fi is a whole category. Who here has heard of AI-fi? Okay, thank you for saving me. I felt like an idiot. Okay, great. So AI-fi is this whole idea that you can tokenize and finance like GPUs and other components of data center infrastructure that are sort of the core capital inputs to provisioning compute. I think that's an interesting category where you start with something like GPU financing, and then you expand out from there to financing electrical infrastructure and maybe eventually entire data centers. And a data center has a cash flow, right, that could potentially be a very large business. So I think at the application level, we're seeing kind of this land and expand strategy. I think the question really for me is who is going to win at the end of the day? That's always the question. What protocol is going to win in terms of what is the home of the majority of the assets? I am not a believer in the multi-chain vision. I don't think we're going to have thousands of blockchains. I think there will be 4 or 5 key chains that gather sort of the most liquidity. I think Bitcoin has earned its spot in that, right, as kind of this reserve bank of crypto. I think Ethereum, Solana right now are kind of the other 2 top contenders. We're seeing a ton of activity with RWA's, pardon me, tokenization on top of Solana. There's a couple of contenders emerging, but I think that is the real question, is what core piece of protocol infrastructure is going to be one of those 4 or 5 winners? And then I think the question is, how do you actually facilitate real interoperability in a trust-minimized sort of manner amongst those protocols? And then the question is, what crypto-native institutions will emerge that will help facilitate some of that? I think there are a couple of really large crypto institutions that should be SIFIs. Like Binance is effectively the systemic institution of the crypto world. So I do think there will be a role for crypto-native institutions to play when it comes to interoperability and sort of aggregated liquidity and being that front end. I don't know. That's
happy to add a comment about that. I think, so on the question about fragmentation, I think there's the chain fragmentation, and then there's also just the stack fragmentation. It's like, it's logical to see that there are going to be institutions and teams that are going to look to vertically integrate solutions, whether through acquisition or through expanding their product set. Once they get some level of traction, that starts to make sense. We saw the recent announcement by Securitize on convergence. I think that there's one aspect of it, which is you have players that are going to try to vertically integrate what offering that they are able to put in the market, so that there isn't so much fragmentation. And then obviously the chains, and we believe kind of in this idea that there will be these incentives to create new layers of core network infrastructure. There's going to be, I think, at some point, a limited demand for the next one and the next one and the next one and the next one, if there isn't a clear value proposition there. And as the economics start to change for those, right? So I think that that's where we view like the general like cross-chain and multi-chain kind of expansion taking place. But we do think that there's going to continue to be different types of runtimes based on different trade-offs that different blockchains make, and that tools and protocols like Wormhole and others will be needed to create messaging across all of them. And then getting to one other point, which is, what is the future of this? Like, what is the point of this? Is it just like reflecting what's already out there in the quote unquote in the real world? I think that another area that's really interesting for us is we're very big into the concept of decentralized physical infrastructure. And the fact that blockchains and tokens create new forms of bootstrapping these networks, governing these networks, incentivizing and providing like monetizable benefits to participants. So whether those are the Heliums of the world or those become like GPU kind of contributors to a GPU network, we think that whole sector has obviously received attention within the crypto community around this excitement around DePIN. But we think as people like kind of move away from the name or the title itself, this concept makes a lot more sense once things become more and more tokenized, when the format and the standards around tokenization start to become more institutionalized or at least more trusted. That infrastructure, providing communications data or GPU data or GPU service or cloud infrastructure, that's variable globally in terms of where it's available, when it's needed, based on time, based on cost. The demand changes rapidly, and having a system that allows you to trade and price that in a more granular way and be able to trade that 24/7, I think is like, there is no comparable platform other than these types of tokenized infrastructure. And I think as more and more of that activity, I would consider that more like real activity that's actually, that people are interacting with on a day-to-day basis. When that moves over, I think all of this infrastructure will become essential.
So there are a lot of different points here. Yeah, look, I think the fragmentation is natural in industries as they evolve. Like when new technologies emerge, like everyone enters quickly, but over time there's consolidation, and you saw this in search engines or cloud computing. And I agree that there are maybe going to be 5 blockchains at the end of the day that account for 90% of all on-chain activity. And then there'll be a longer tail of 10% that are more specialized, that are more permissioned. I think permissioning is a key element that we need more work done on in the space. I think convergence is a good step in that direction. KYC, AML, and knowing your customer, and that KYC point either happening at the chain level or at the application level or at the smart contract level is absolutely critical. In terms of where value accrues, like I'm actually just skeptical that there will be a tremendous number of winners behind tokenization within the blockchain space. I think a lot of the value will accrue outside of crypto native. So you look at like Robinhood on their earnings call a couple weeks ago, the CEO is focused on tokenization, tokenizing private company stocks, having 24/7 trading and settlement, and actually kind of like rebuilding DTCC. I think BlackRock has a similar long-term vision. So I think a lot of the value will accrue outside of crypto native. Similar with what you've seen with AI, a lot of the value is accrued to to big tech. I think the second way to play the growth of RWAs from an investment perspective is owning the layer ones, because every time an asset moves, a marginal amount of fees get paid to whatever layer 1 token those real world assets are being moved on. Ultimately, I believe the most valuable layer 1 blockchain will be the one that has the most tokenized real world assets on top of it and moving through it. So I think those are kind of the two obvious, or they're not obvious, the two views that I have.
While you're working on solving these problems, what is the regulatory landscape looking like for tokenization? How does that factor into your investment decisions?
I would say post Jan 20th, not as much as before. It's open field day. I mean, our president has his own meme coin. So I think it's definitely a very permissive environment. All of the existing lawsuits that the SEC have for a large part been dismissed. So I think it creates a very exciting opportunity space. We see a ton of people coming back to New York, re-onshoring, which I think is great. Obviously, what's really interesting, did you know Tether is the 18th largest holder of US Treasuries? Tether is systemically important to the US government. This should be much nicer to Paolo in Washington, D.C., given how many treasuries he buys, how much he's bidding. So I just think there's this really interesting opportunity emerging. All approaches are kind of on the table, which I think is very exciting. I think the key question is, I think what you were alluding to, Ben, and what you just said, which I fully agree with, it's really liquidity that matters. I think the big question right now is, what is the future home of capital markets? America is the home of capital markets. I don't know if that's going to change. A lot of people talk about oh, Abu Dhabi, oh, Singapore, Hong Kong. It's still America. And so I think the big question really for most companies is not about regulation anymore. I think it's about where are markets going and what markets matter. And if you're building anything touching quote unquote real world assets or the financial system, I think unfortunately, America is the home for that and will be for the foreseeable future. I think that's the more important question to ask, which is why I always sort of question, when people are offshore in other jurisdictions, why? Because this is the largest capital market in the world by a factor of, many, many multiples. And I think similarly, it goes back to the point of protocols as well, right? Protocols that are going to win, it's about liquidity aggregation. I don't know how important the regulatory conversation is anymore, and that's an interesting place to be. This is year 10 for me. The only conversation always has been about regulation and sort of policy, and now that we have everything we've ever asked for from a policy perspective, I think that a lot of founders, some are on the front foot, but many are sort of caught on the back foot, especially if compliance has sort of been your competitive edge. I don't know how long that will continue to be an edge, just given all of the changes we're seeing.
Yeah, just to add to that, I think there's regulation, which is what are the rules, and then there's what are our national interests. And I think the paradigm shift in Washington has been, well, stablecoins are actually very critical for us to win. Right now, the US dollar is used in 70% of all international commerce. 70% of all transactions are done in dollars. So we have the dollar hegemony in kind of Web 2. Why would we not want the dollar to be the de facto reserve currency of the internet of blockchains? Today it is, not because the US has supported it, but every stablecoin that's issued is basically going to buy a US Treasury. So the more stablecoin growth that we see, theoretically, the lower the cost of capital of our government. And we have 10 trillion of debt that we need to refinance at the federal level in the next year. So,
let's go.
So we should be, the US government should want stablecoin growth. That should be the baseline kind of desire, because I think it's only in our country's best interests.
Yeah, I'll push back a little bit, Meltem. I think regulation obviously has been something that's been hanging over as a kind of excuse to some extent on adoption. People would say, oh, well, until there's regulatory clarity, we can't really move the needle significantly. So now what's the excuse? I think the reality is most of the world has already created legislation around tokenized securities, tokenized stablecoins. Japan did it back in 2020 with tokenized securities. They had stablecoin related regulation in 2022. You see it in MENA, you see it in the EU. The US was the only one not to really have anything constructive in the space. They just had views on whether something was or was not a security. And obviously a lot of punitive action that was taken over the last few years. I think regulation is a big tailwind for this sector. The main point, though, is that once legislation like the Genius Act and others are moved forward, having institutions like banks issuing stablecoins is going to bring a lot more liquidity into the infrastructure that we're talking about. And I think that regulation up until now was not really moving much of the progress in the industry, primarily because most policymakers never saw this as a priority area, right? So even if it came up, it was like priority number like 15 or 16, if anything. I was involved in the Libra project. We met with many policymakers. And honestly, like, even if they showed interest in it, it was just nowhere near as important. And now, because of volatile interest rate markets and the changes that are happening from year to year or quarter to quarter, and the geopolitics of it, as you just mentioned, really have pushed this concept of like, we need to deal with this now, is actually, I think, pretty catalytic for us, right? So we haven't necessarily seen it play out fully, but once Genius passes, I think whether it's Robinhood, whether it's private banks issuing these types of assets, I think is going to make a huge difference to the industry. And I think that over time, we'll start to see that mature through to the rest of the sector, I think.
Yeah, a lot of food for thought, and we're out of time. Thank you, everyone.
Thanks, Vicky.
All right, folks, we're going to take a quick intermission. So thank you all for your attention for this first half of the agenda. I hope you brought your real-world appetites. We have lunch and coffee outside, so we'll be back here in a half hour with the fantastic second half.
timing. I've got about like a 10-minute intermission right now at the conference on that. No. It's perfect timing. I've got like a 10-minute intermission until we start again. Okay. Oh yeah, I'm here. No way. Okay, good to know. To actually use the dock. They probably keep the permit. You have the permit. I think they might take the dock. Interesting. Okay, because they give you a permit, but you got to bring the dock. Yeah, that's all like linear, exactly. I wondered that. That's what I was at. Yeah, that's why I wanted you guys to do that walk. I'm glad you did. Because the pictures weren't forthcoming with the walk to the dock. Okay. Well, yeah, and I wonder if that's like how difficult it is. Like when you use the owner and you have to like involve. I'm sure you do that. The army. Oh, really? That's what the seller's agent was saying? Okay, yeah, yeah. I mean, it's basically what the pictures are, I would imagine, is the furniture that's in there. So even though he was only there for like, a year, I mean, the pictures look like it was recently updated, like, and well-maintained. Does that feel true? That's what happens when you don't come out. I wonder, did they say about the plumbing? Did they say about the plumbing But is it, because like in my mind when I saw that, I thought the same thing, but I was like, oh, you could probably just like put a couple layers of chicken wire like in between, like around the entire thing, and address the gaps, or is it like the wooding and the support system feels wobbly and you probably should replace the whole thing from the structure layer versus the gap? Okay. How did you feel about like it's interesting. Amy, you said an office. In the pictures, I didn't even see an office. Well, and were all the beds, so the way I understand it from the pictures, it's 3 bedrooms upstairs and 1 bedroom in the basement. Okay. Well, the basement, if the arcade games are there, like in reality, like they are in the pictures, honestly, I probably would have like just my desk area down there. Yeah, that underneath deck part. And then it's in the basement. It's just that like room, and then it's a bedroom and what, like the half bath is down there. Oh, but is there like? But it's the bedroom down in the basement. But then there's like a bathroom, a toilet, but no shower. Is that down in the basement also? Well, because the listing says it's 2.5 bathrooms, so I would imagine the 2 showers are upstairs and the toilet's downstairs. Okay, and then the washer dryer, that's downstairs also. That's all right. We can look at the videos. Okay. Interesting. Okay. It seemed like the kitchen and the like the main living room was like the nicest level by far. Oh, in the neighborhood, I mean, honestly, that's the neighborhood I look at most consistently because you can pay $30 a month to join the HOA and you get access to a community like pool and tennis clubs and clubhouse for like a very cheap price. Yep. I mean, and there's so many, and it's interesting, and it's the property itself is interesting because, like you were saying, Andy, like it's a long driveway to get to, like it's a long like private driveway, which is like the property line essentially, and then like the driveway and maybe a little section of the right of way, but that's really it. Yeah, because No, no, I was just saying, it's from what we've seen in the areas we're looking, which is fairly expansive on the east side of the mirror, I've already eliminated the fact of having a real yard if we end up on the leg, which is unfortunate, but you're right, we pay for the dock. And I do love the woods. What did you guys meet Matt, the real estate out, the buyers? Okay, he's a nice guy. Yeah, did he comment? I mean, I don't know if you three spoke privately afterwards. I'll end up giving him a call, but because I was asking him last night, now he hadn't seen the property yet, if he thought, because like even with all the issues and whatnot, it's just a matter of price at the end, you know, because you get X amount off and you can put X amount of dollars into it and then it's raised, you know, so maybe the price isn't exactly what it should be for some of the changes, especially maybe they smell right, but I hate the thought of it. My friends have actually got their entire house and then we've got the catch for a while. Oh, totally. Aw, that's so nice. Definitely. Oh yeah, definitely. You gotta be airtight on that type of stuff. It's okay. Yeah, it's so interesting because it's like around the corner a very similar property. Almost same square feet, same bedroom, baths, style. That's at like 1.2 million, but it's been sitting on the market for like 4, 5, 6 months at this point. This one's priced a little lower, so it's just maybe we're gonna end up. We'll check out the videos. We'll want to do this again with you guys tonight, I'm sure, the right thing. So yeah, thanks for coming. That's super helpful information having your eyes on it.
All right, how's everybody feeling? We feeling good? I think I need to stretch a little bit to let this room fill up a little bit, but I hope you put a nice base into your belly, obviously, after lunch, because we have a happy hour at the end of today's agenda. That happy hour, of course, is sponsored by ZK Sync, and we want everybody to make sure they're networking and meeting everybody, of course, and doing all that. So coming up next, though, we do have a discussion about blockchain networks, driving tokenized asset adoption, and institutions as well. So we're going to have representatives here, including Nick Dukoff of Solana Foundation, Pearl and Bach of Matter Labs and ZK Sync, and Morgan Krupetsky of Aave Labs. And this discussion is moderated by Jacqueline Melinek of Token Relations.
Welcome back, everyone. I hope you enjoyed your coffee break and you are more than ready and excited to talk about blockchains, tokenization, institutional adoption, all that fun stuff. I'm Jacqueline Melinek. I'm going to be the one moderating this conversation, and joining me today is Pearl from Matter Labs, Nick from Solana, and Morgan from Aave Labs. I'm excited to have them all on here today because they all come from very different ecosystems. To start off, as the title suggests, I want to hone in on the word adoption. I feel like we are constantly using it, throwing it around out there, and I think mainly inside the Web3 space, but then also outside of it. So for each of you, to lay the land, when you think about adoption of tokenization from an institutional perspective, what does that really mean to you today?
I can go first. So I think in terms of institutional adoption, what we've seen today so far, especially as it relates to traditional institutions adopting blockchain and tokenization technology, it's really been mostly concentrated among asset managers who've been interested in issuing and tokenizing kind of their suite of assets on chain, mostly for crypto native businesses. And so the direct kind of view of that is, there's 200 billion of stablecoin market cap on chain today. Let's see if we can convert some of that into kind of our suite of assets, starting with money market funds. And then the idea would be to go further out the risk and duration spectrum. I think what we would love to see from an institutional adoption standpoint is really asset managers starting to provide liquidity and actually being the buyers of these tokenized assets. We'd love to see kind of banks, traditional banks and broker-dealers offering custodial capabilities for tokenized assets, SEC lending, secondary market trading, and really kind of growing out the suite of institutional capabilities and utility, which I know has been talked a lot about today. And then ultimately seeing various types of platforms, RIA channels, traditional wealth platforms, ultimately offering tokenized assets to their clients who in turn, most likely of which are off-chain today. So we're at the beginning, but I think ultimately when we mean by adoption, we really want to see institutional capital kind of being provided in the space.
So when I think about adoption, I think about product market fit, and I'm going to answer the question a little bit differently. What has TradFi really found attractive in our broad ecosystem? Clearly, they have found Bitcoin attractive. If you look at IBIT, BlackRock's Bitcoin ETF, it's the most successful financial product in the history of all time. So clearly, there is demand to take digital assets and wrap them in ETPs, ETFs, et cetera, and I think we're going to see more and more of that. And then on the other side, I think stablecoins are the clearest case of product market fit on the blockchain. As Morgan mentioned, there's nearly $200 billion of stablecoins on chain, and I think something in the order of magnitude of 1/10 of that or less of more traditional RWA on chain. So clearly, that is where there's the clearest adoption.
Yeah, I mean, in general, like you also said, we're still far off. We do see that more and more institutions either are studying it or are trying to test it, and we get more and more people also really understanding what it's about, and they see what the blockchains are of the advantages are of blockchain tech. But we see also players wanting to be part of this story for wrong reasons, I would say, just to get like a piece of an ever-shrinking pie, which is the Web3 users, Web3 companies, but instead it should be the other way around, right? Also what Meltem said in the previous panel, this we don't see enough yet. We don't see enough like real use cases yet where they actually leverage the benefits of blockchain and try to get new users on chain without them even knowing it. So providing the right UX, having them experiment with the advantages of it without actually realizing that they are using an on-chain tech and that they don't have to sign 3 times to do a swap, for example. That should also be part of the past. And I think we're getting there with better UX and better offerings, better integration with legacy systems, but there's still a long way to go.
Mm-hmm. I do agree that it has to be extracted away. Otherwise, it's not going to be accessible, especially for institutions. Like, they already have enough complexities in their existing systems, right? Nick, you also brought up stablecoins as something that is like a clear use case. And I think a lot of people in the audience would probably agree with you on that. How do you see that playing into institutional adoption? Like, what do they want to do with stablecoins that they can't just already do with dollars?
Well, stablecoins provide a great settlement rail. It allows folks to buy any asset in any denomination and settle it against a stablecoin, and I think that's a pretty powerful use case. There's, of course, also the payments use case for stablecoins, which we're seeing both in terms of cross-border payments, remittances, and the like, and increasingly even potentially, enterprise stablecoin utilization for things like repo markets and intraday liquidity. And so I think it's all very exciting. The thing that I worry about is the fragmentation of stablecoins. I think as banks get the green light from the current US administration, they're all going to be looking to have their own, bring their tokens, to the market, whether that's, JPM coin or something like that. I think each bank is going to want to bring their own version of their stablecoin, tokenized deposits in a stablecoin, and I think we need to solve for liquidity.
Mm-hmm. Yeah, I also think on the flip side, there's probably things that they don't want. What are some of the things that they're like, please no more of this, or we've been pitched this so many times, we don't see a purpose in this? And do you see that as like, okay, maybe they need to be better educated on this, or they have a fair point when they're saying we don't want X, Y, Z, or whatever it is?
So I think we've not come to the point yet where, especially banks, aren't necessarily making the connection of how tokenized assets could be improving the product, services, and capabilities to their existing customer base. So they necessarily haven't made that leap of how do we, to your guys' point, abstract away the complexities but offer incrementally new capabilities, whether that's like more efficient SEC lending or peer-to-peer transfers or providing liquidity into an AMM pool. Like these are the things that I feel like should be talking about and thinking about and speaking about them in the business terms, the implications, but they haven't necessarily made the leap yet of offering these assets to their traditional and embedded client base, and instead are still very much thinking, how do we offer this to net new customers and crypto natives? So I think once that kind of leap happens, we'll start seeing much greater kind of adoption inflows. But again, to your guys' point, it really needs to be abstracted away.
But just to hone in a little bit on that, on banks going on chain and offering these things to their clients, it's sometimes a bit of a paradox, right? Everyone is into crypto. They say crypto is financial freedom. We want to cut out all the middlemen. We want to do it ourselves. But reality is we're still a very small community of people actually doing stuff on chain and being familiar with how these things work and how crypto works. And most people, in my opinion, will not be okay with self-custodizing. I would always want to have this trusted middleman that they can blame someone if something goes wrong with their assets, someone who actually gives them the right advice and gives them this sense of security, right? So I think that will still be the world we will go towards, that some will self-custodize, some will always want to have a trusted middleman. And banks are actually in the perfect position, I think, to bridge TradFi and DeFi. They're the ones who can do the onboarding of billions. They have the infrastructure, they have the regulatory trust, they have experience with compliance. They're also the ones that can then offer tokenized real-world assets directly to their clients, the existing products, but also offer new products to their clients that they didn't have before. They're also perfectly equipped to create very efficient on-chain lending markets, make them completely decentralized and accessible to their clients once again, so they can actually decide for themselves what they want to borrow against. And yeah, I think lastly would be still the whole KYC part. I don't think that will ever really fall away. The fact that someone actually needs to make sure that they're properly KYC'd, and also that someone has done due diligence on investments, that someone is there to give advice in case of need.
Mm-hmm. Nick, I see you nodding. What's your thoughts? Just agreement?
What's the question? I mean, is the question, are banks going to be the ones that lead us to the promised land? I would say I would disagree with that.
Hey, I didn't ask that. Okay. If banks would lead us there. I guess it's more like, what don't they want? When you're having conversations from the foundation at Solana.
The banks don't want crypto.
So how do we change their minds on that?
Gasless relayers. I mean, so one of the things that's been hard is there was SAB 121, which made it virtually impossible, and Operation Choke Point, and Choke Point 2.0, which basically made it impossible for banks to hold any crypto on their balance sheet at all. Now those have kind of gone away. But we don't know exactly what the rules of engagement are because there's no legislation that tells them what they can do. We just knew what they couldn't do, and now we know that they maybe can do those things that they couldn't do. But until they get very clear green light with legislation, I think that they're going to take a very cautious approach to this and still not really mess with crypto. And so to use any blockchain, you need the underlying gas token, right? Like to use Ethereum, you need ETH. And so I think one thing that banks would rather not have to deal with is crypto at all. So to the extent that you can make that automatically disappear for them and they can use the blockchains without having to hold crypto for themselves, for their customers, fine. Custody is a great business. But for themselves, I think they would rather not.
Well, just to go further a bit on this, I didn't say crypto, I said digital assets. It's not the same thing. So I agree with that. Banks will not want to touch crypto, and they shouldn't have to touch crypto. So they should just be able to have their own chain or be on a chain that is private for them, permissioned for them, and that they do not have to hold any ETH to. I agree with that 100%. They should just have their tokenized deposit or their stable coin as they see fit and have some, like you said, gas stations in between to do that for them. But 100% agree with you on that one.
We're in violent agreement.
In terms of tokenization, then, I want to talk more about that. Pearl, I know before we previously discussed that maybe not everything needs to be tokenized. Maybe everything can be, free markets, sure, but can you kind of discuss like where do you see the bigger purpose in this and why you feel that way as well? Sorry, I'm outing you.
No, I did say that, and I still stand by it. I think just tokenizing a money market fund for the sake of tokenizing it and for marketing.
It looks good, though.
Yeah, it looks great all on paper, but what is the benefit? Like if my bank offers me right now a money market fund or on chain, what is the difference for me? Why would I make it sometimes more complicated, sometimes even more expensive by going on chain? There's no real point unless you actually give the users a purpose for holding it. Can I use it as collateral and borrow against it myself without having to ask someone for permission? That's interesting. But just for all these companies now to say, oh, Biddle did something amazing, we got 1 billion AUM, we will also put a money market fund on chain and we will ask the Web3 companies to invest, but we don't have users that are interested, we don't have a distribution strategy. There's no point. And I'm also not supporting that use case.
Yeah. What do you two think?
Agreed. But I also do think sometimes we kind of like take for granted the accessibility question around, especially around dollar-based savings accounts, euro-based savings accounts. I think a lot of the partners that we're working with take very much a kind of B2B2C approach to go-to-market and distribution, and in turn are working with companies who are offering dollar-based savings accounts, for example, powered by whether it's money market funds or stable coins to investors, customers who don't necessarily have ready access to dollars or to dollar-based savings accounts. So fully agree with Pearl in that there needs to be a very concrete utility or accessibility compared to what someone, whether it's an institutional or an individual, can access via the traditional system. And so that definitely needs to be the case. But I think what we're finding is, especially on the stablecoin front, interest to adopt the technology in the back end among neobanks, wealth tech platforms, embedded finance platforms, who in turn have distribution and who are offering differentiated products and services, leveraging kind of tokenization in the back end.
Building on what Morgan said, one of the things we're doing to kind of put in practice a real-world use case for these tokenized money funds is, in the ordinary course of all three of our businesses, we probably give grants to teams all over the world that may not have access, certainly to the dollar, and may also not have access even to interest-bearing bank accounts in their local markets, depending on how the organization is structured. And so we're now giving grantees of the Solana Foundation an option to, this is through Franklin Templeton's Benji token, elect to receive their grant in Benji. So it essentially serves as their on-chain interest-bearing bank account, not a bank, right? But dollarized, natively interest-bearing, and there's no hacking risk because it's a security that can be kind of seized and freezed or what have you. So it's kind of a nice safety feature as well.
Morgan, you talked about real utility, which I think is something that we would all love to see. And I know at Avalanche, there's been a lot of announcements alongside institutions. In terms of creating value, what are you kind of seeing on that front? And where would you like to see Avalanche and the broader institutional adoption kind of like grow and flourish?
I feel like there's a lot of questions in there.
That's what I do best. I throw like 5
All the
questions in
things.
one, and you got to pick.
Well, so I think, I mean, ultimately, we're definitely vying for adoption as it relates to everything that I mentioned in the first instance. I think to Pearl's point, there's a lot of times that projects are vying for and fighting over like the same 5 users of crypto of which we are 4. It's like, why don't we work with companies who in turn have distribution to ultimately bring off-chain liquidity and off-chain capital on-chain by nature of offering really compelling products and services with a slick UI and a UX. And that's going to be the thing that I think will ultimately see greater quote-unquote adoption from a tokenization standpoint. So from an Avalanche perspective, we're very much focused on cultivating an ecosystem of builders who are like-minded in that way, who have very much either a B2B or a B2B2C kind of go-to-market and are ultimately vying for real-world adoption, whether it's in institutional finance, which is where I'm focused, whether it's DeFi, gaming, enterprise, whatever it is, but that's kind of the overarching goal.
How does Solana and Matter Labs look at this?
Well, I think there's a lot of things that Solana wants to be when it grows up, but one of the things we talk about a lot is this idea of internet capital markets. So, can we help provide the technological infrastructure to support a financial everything store at NASDAQ speed, where you can take any asset, immediately trade it for any other asset, fundraise on the technology platform, and kind of be a one-stop Wall Street shop, for all of your on-chain and kind of traditional financial needs. So that's one thing. The second thing is this idea that we call PayFi. So it's the idea that you can take those financial assets and use them in the ordinary course of your life, whether you receive them, like I was saying, as payment, or for your wages, or use them in commerce. This idea of taking your phone with your on-chain wallet and using what's in it, without ever having to worry about moving money, taking your bank account, moving it to pay your bills, pay your credit card, using this, using that account, having everything in one place, I think is a really powerful vision that I think are getting closer and closer to.
Yeah, maybe I should also explain Matter Labs. They're core contributors to ZK Sync. I didn't say that before, but we also have the ZK Stack, which is an open source code framework for enterprises to build their own chain. And I think depending on the needs, the use case, but also the jurisdiction they're in, they require a different type of chain. Some of them needed to be private, others needed to be public and permission. So we can tailor it completely to the needs of the specific institution and the use case. But also what our stack provides is trustless interoperability. And that I think is really important because there's literally no middleman. They don't have to trust anyone but themselves. And also no chain can be evil. They cannot cheat because they're all ZK powered. So if their transactions are not correct, there's a malicious one, it will not go through. There will not be a ZK proof made for this one. So all these chains are in itself trusted chains, but when they interoperate, the only thing they have to do is basically send a ZK proof together with a message that they want to make this transfer. The other one can read that. They can verify against the ZK proof and accept it, and that's how they will all interoperate. So we're envisioning this network of chains that are all tailor-made depending on what the use case is and what the clientele is, etc., and still for them to seamlessly interoperate. So in terms of distribution as well, you could have a tokenized fund sit on one chain, but still have the users of another chain buy them seamlessly with the best UX because you don't even know that you're jumping from one chain to another. It's just a click like you're swapping on a Uniswap, but better, and have the token on your chain and very securely, never having to trust a middleman. And that, I hope, is what we can keep developing.
You all work at very different organizations that are focused on different chains. Do you see a future where it would be multi-chain and interoperable between them for institutions to kind of weave in and out through each of your ecosystems? If so, what would that look like?
Sure. So yeah, I think like if you ask anybody, everyone believes in a multi-chain future. So I think inherently you will.
Well, Meltem Demirs was just up here and she said she did not believe it.
Okay, most people believe in a multi-chain.
4 or 5, so maybe we're good.
Sure. So I think like inherently you will need interoperability, and obviously there's a lot of projects out there that are kind of focused on that. Maybe like a hot take from my side is that I think that any application or business that reaches true product market fit in the space will want and necessitate its own chain, its own layer 1 blockchain for a lot of reasons, which find me after happy to talk about. But I think we will start seeing kind of these chains, whether it is a crypto native platform reaching true scale and product market fit, or a large Web 2 company kind of coming into the space and building a series of applications. They will want their own layer 1 blockchain. They will be able to kind of fully maintain and build value into that platform, into their token if they have one, and kind of customize and really own their end-to-end blockchain environment. But inherently, that will need to be interoperable with other chains and other assets. And so I think we'll start seeing kind of the proliferation of that. And I mean, frankly, we had Converge today, right? So they're building their own chains. So I think we'll start seeing more of that, and inherently they'll have to be interoperable.
So just curious, who here in the audience thinks the world needs more blockchains? All right, there's 3 people.
I don't mean entire blockchain networks, right? They can be Avalanche L1s, they can be Cosmos chains, but I think inherently we'll see that.
We were slacking about this yesterday, actually.
It's a private conversation. I also want to touch on the regulatory point. I feel like that's been discussed throughout the day and just in conversations in general. The industry has gotten maybe a sense of relief on this front, at least in the US and maybe more broadly in other countries, but we're in America right now, so we'll talk about that. What are the biggest challenges that remain for you to kind of conquer to make sure these institutions feel like they could actually come into this? Because in the beginning, we did discuss, like, hey, there is these regulatory hurdles that are still there.
We need a stablecoin bill. We need something that looked like the FIT bill or whatever replaces that. I think at a start, we need those 2.
Agree. Yeah, same. I think like what we also will need to say, I think, yes, regulation was one thing that was kind of highly cited in terms of like a blocker. So obviously, post-election, a lot of that has started to clear up. I think stablecoin regulation will be really helpful. But I think what we really need to see the tipping point is for a Web 2 company, whether it's a neobank or a wealth tech platform, one of these that is not necessarily like a traditional incumbent bank, but maybe a challenger that really starts to adopt the tech and start really kind of gearing up its business, building a moat. And that's when I think others will start to have FOMO and kind of come in and really start to like ramp things up on their side.
Haven't we seen that a bit with JP Morgan though?
JP Morgan?
Yeah.
I don't think we've seen.
And Onyx, like the blockchain. The it girl is not here. It's funny you use the words tipping point, because that was going to be my last question, is like, what would be the tipping point where, we feel like it's fully adopted and tokenization from institutions is like fully implemented? What would that look like?
Well, you just mentioned JP Morgan. I think on the next panel is Robbie Mitchnick from BlackRock. And of course, we're here at the Securitize Wormhole event, and BlackRock BIDL, surpassed $1 billion AUM, and Larry Fink gets up and he talks very positively about this space. And so clearly they have executive sponsorship, to do what they do in Robbie's group, in the digital assets group. At JP Morgan, Jamie Dimon, he gets up on, stage and he does not speak positively about this space. And so I think when you get Jamie Dimon up here saying how much he loves blockchain, how much he loves crypto, that's the tipping point.
Well, he's coming up. Surprise guest.
Awesome. Great. There's room.
Amazing.
Maybe also once we stop calling it TradFi and just finance, that's what we'll know.
Fi. It's cleaner.
Final thing. What do you all want to see happen by end of 2025 in regards to everything we talked about? What would make you feel like this year was a success? Pearl.
Not by 25. I'm thinking much more longer term.
We got to go near term.
Yeah, I would love that it all happens this year, but people are like, yeah, now it will all happen this year. It will take a bit longer. It will take a while, I'm sure. But like ideally, in an ideal world, I would love to see a whole tokenized economy. where we wake up, have a workout app, do a workout, you get tokens for that, but you're also an investor in the same workout company. So, oh, wait a minute, you get your shares just went up in value. You go to get a coffee, pay with a stable coin, get your loyalty rewards, and you're all in your wallet. And then you see how your AI agents just did today, and oh, you made so much money. I'll put it in a risky tokenized fund. That would be, of course, the ultimate goal. And then in that way, you have companies accessing new capital because you have all these users that then actually become a shareholder. And also for the people, you have access to new assets that are now not so easily accessible to you. And that is what I hope we will go towards. But that will not happen this year, of course.
Yeah, I don't think that's by the end of this
Well,
year.
I agree, and I want to see Pearl's vision in reality, and I think you get there with founders, applications, and tokens. So we need more butts in these seats. We need more people who have a vision to be, financing and building the applications that they want to see in the world, and more tokens, all the tokens, bring them on chain.
Yeah, I mean, I would just say kind of what I said earlier. I think we'll see this year some of these like Web 2 challengers really start to adopt, especially stablecoins to start, and then potentially kind of go out, maybe even see tokenized equities this year as well. But I think we're going to be working toward that tipping point from kind of like a Web 2 adoption standpoint, which I think will really help to kind of open the floodgates in terms of kind of broader off-chain adoption as well.
Yeah. Well, Pearl, Nick, Morgan, thank you for sharing your insights, and thank you to everyone for listening in.
Thank you.
So with the new US administration comes fresh opportunities for progress in digital asset policy. But meaningful action is key. For our next panel, join Amanda Tuminelli of the DeFi Education Fund, Jake Chervinsky of Varian Fund, Kathy Yoon of Wormhole Foundation, and Rebecca Rettig of Jito Labs as they break down what's ahead in a discussion moderated by Yvette Valdez of Latham & Watkins.
Oh my God.
Hello, everyone. Thanks for joining us, and I'm excited to have this conversation with everyone. My name is Yvette Valdez. I'm a partner at Latham & Watkins and co-chair of the Digital Asset Group, and I am joined here by this esteemed panel, Rebecca Rettig, Jake Chervinsky, Amanda Tuminelli, and Kathy Yoon. Before we get started, I want to just take a second to allow them to each introduce themselves, and then we'll kick off.
Sure. I'm Rebecca Rettig. I'm the Chief Legal Officer at Jito Labs. We build all sorts of staking and other infrastructure in the Solana ecosystem. And before that, I was at a number of other projects and builders in the space. I've been in crypto as a lawyer for 8+ years. Jake and I sort of started together doing this, and have been thinking about regulatory and policy issues unofficially and officially for about the past 5 or 6 years, just because I think once you started knowing the technology, regulators and policymakers were looking for people to explain, and so lawyers, for better or worse, were some of the people who they chose to do that. So yeah, happy to be here with everybody.
Awesome. I am Jake Chervinsky. I am Chief Legal Officer at Variant. We are a venture capital firm focused on early stage crypto companies across the entire industry. Before my current role, I was Chief Policy Officer for the Blockchain Association, which is the industry's main trade group in DC. So working with Congress and regulators to figure out what does good regulation look like for the industry. I'm now on the board of the Blockchain Association. It's also my honor to be on the board of the DeFi Education Fund, along with Rebecca, where Amanda works. So I'll turn it over to her.
Hi, I'm Amanda Tuminelli. I'm the Executive Director and Chief Legal Officer at the DeFi Education Fund. We are a nonpartisan nonprofit. We advocate for sound DeFi policy that looks like impact litigation. That looks like working on draft legislation, doing comment letters on proposed rulemaking, and really just showing up for software developers everywhere and anywhere that we can.
I'm Kathy Yoon. I am General Counsel at Wormhole Foundation. I probably don't need to go into what Wormhole does anymore after all the panels that we had today. I'm also on the advisory board for New York Department of Financial Services. Yay, New York. Yay or nay. And like Rebecca and Jake, I've been in the space for a very long time. And I think it's super exciting where we are today from where we started. But I think we still have a lot of growing to do.
Absolutely, and we're going to talk about that now. So there's obviously the direction of travel we're in right now is very different from the crypto winter that we all came out of. It's incredibly sunny and we're all getting tans. But I think that it's actually really important to sort of talk about that, right? Like, what does that actually look like for developers and technologists? Like, do we have carte blanche to effectively continue to build without any worry, given the regulatory headlines are no more regulation by enforcement? I mean, really, what is there to worry about? Jake, do you want to take this one first?
Yeah, sure. The short answer is no. We don't have carte blanche. The laws are still on the books, and we still have to pay close attention to figuring out how can we comply with laws and regulations that are really important, not just for mitigating legal and regulatory risk, but also for building good projects that people are going to want to use for many, many years to come. And this is a question I get all the time in my day job working with founders in my portfolio who are pre-product. They're trying to figure out, how do I launch something that will mitigate my legal and regulatory risk? And so I'll give you the short version of what I tell them, which is things are very different from how they were 6 months ago. Enforcement risk is significantly lower from agencies like the SEC, which was saying 6 months ago that basically everything in the crypto industry was in some way a violation of federal securities laws. That's not the situation we're in right now. However, the law has not changed at all. We do not have new regulations on the books. We do not have new legislation through Congress. And what this means is there is still significant legal and also regulatory risk. A lot of that comes from private plaintiffs' class action lawyers who are filling the gap that regulators are leaving, filing lawsuits against companies that can be just as damaging or destructive as a regulatory enforcement action. And the other thing is, if you want to build a product that's going to survive for the long term, you need to know what the regulations are, and you have to build to spec to meet those regulations. And so what I tell founders is, you should be aggressive, and this is a good time to be risk tolerant, but you also have to pay very close attention to what's happening in Washington so you can understand what the regulatory framework will be once it comes and make sure that you're building to comply with that framework.
I actually would say that I think it's more important than ever to think about where the regulations sit, because we're at a pretty important crossroads right now. I think everybody in this room is building in a serious way, right? We're at a fork. Are we building serious products for serious people that we want a mass group of people to use? Or are we just going to keep building sort of something where we were very constrained because we were all afraid of getting SEC subpoenas all the time, and so maybe you didn't have the most serious people always building the most serious products? And if you want to be on this path, which clearly everyone in this room seems to be on, and I think a lot of the industry is moving on the serious people building serious things path, then you do have to think about legal. You don't necessarily have to assume as a cost of doing business that you're going to get a subpoena from the SEC, because I think as lawyers, I certainly used to say that, like, just a cost of doing business, you're going to get it. Doesn't matter what you're doing one way or the other. And you should put aside, like a pot of money to be prepared to fight the SEC regardless. And so we don't have that anymore, but it doesn't mean that you should go out and be irresponsible. I think one of the things we have to do as an industry is also try to meet the regulators where they are in many ways, or show the regulators the path forward and take proactive steps to be transparent, to do a lot of disclosure, and to be responsible actors in the space.
Yeah, I mean, I think a few panels ago, Meltem said it was kind of open season and that she wasn't really concerned from a regulatory perspective. I love Meltem. I love hearing her speak. It's not open season, though. I wish it were. My team comes to me all the time, and they're like, we can, let's go, full throttle ahead. We're going to go and do these things. And I think I personally have said no more in the last 60 days than I have in the last 7.5 years that I've been in this space. And it's frustrating for me because I want to build, I want to move full steam ahead, but there is still a lack of clarity, unfortunately. And we have other existential risks and crises that we also have to deal with in addition to, the SEC and other regulatory agencies.
And yeah, I would just pick up on that. I think one of those existential risks is the Department of Justice. Everybody is very concerned or talking about regulators and Washington being open for business. And not to be a Debbie Downer, but the Department of Justice has not given any signs of stopping their criminal prosecutions against software developers. So there is currently a pending case against Roman Storm, one of the developers of Tornado Cash. There is also a pending case against the developers of Samurai Wallet, and there are non-public investigations against other software developers for running unlicensed money transmitting businesses. And I will not bore you with all of the details of that.
Although one detail is important for like DeFi
we
protocols.
will bore you with the details.
No, but for DeFi protocols, right? Like
Yes.
they're investigations of people who built DeFi protocols. Sorry, I think that is
for people building permissionless, non-custodial software are still being targeted by the Department of Justice for doing a thing that requires control over user assets. So the law for that is certainly on the books and has not changed, and unfortunately the DOJ does not seem to be changing anything that it's been doing recently.
So I think the takeaway here is proceed cautiously. But maybe we can do a little bit of aspirational, Amanda, and pivot slightly from Debbie Downer, because I actually think we've come a long way from November even. And as Kathy said, we've got a ways to go. But actually, let's get into that. Where have we gotten to today from November, which actually is quite a bit, despite not having legislation, and where are we going? So each of you, I'd like to hear, like, what are the best achievements and what do you want to see happen in the next 2 years, since we really need to get all this done before midterms?
I wouldn't say it's the best achievement. I'm a little annoyed that the SEC's first guidance was on meme coins. But it's only because there were so many other things, and I get why it started with meme coins. It's easy. It's an easy give. They listed very specific criteria under which certain tokens are not going to be considered securities. I would love to see that with tokens that matter, and not just meme coins. But I think it's a great step. We're finally getting some real usable guidance as opposed to that horrible token framework that they put out in 2018 that was 80, I don't even remember how many prongs it was. 78, right? I mean, where it was unusable, you couldn't do anything with it. They didn't weigh any of the factors. At least here, this was nice, short, sweet, concise, and I would like to see more of that.
But we've got, from the SEC point of view, notwithstanding meme coin interpretation, right? We've got a crypto task force. We've got sort of this, we see the direction of travel on the SEC. What do you guys think about that?
Having been, I would say, the first industry participant, there were a number of trade organizations that preceded us, but having been the first company that went in to see the crypto task force, I will say, the direction of travel is really fascinating and pretty positive, and not positive like it's open season and we can all do whatever we want, but we are, notwithstanding Loper Bright, which unclear what that means for what the SEC can actually put out and uphold in terms of regulations, but we're going to get a lot more information. Yes, meme coins was easy, but they are taking a 180 approach. They want that from the last administration. I think the fact that every meeting is public, that you have to put something in writing, and they tell you it's going to be public, so you should know what it is, and that it's going to be out there. This is definitely a sunlight is the best disinfectant kind of approach to things, and I think we're going to see a lot more guidance on a lot of the issues that we all care about, including staking, tokens, right? They have their first roundtable on tokens on Friday. So I think we're going to see a lot more from the SEC. And in terms of what we have accomplished, I think we're looking a lot at the regulators and saying, great, we're so happy everything you're accomplishing. But I think the industry has to step back and say, we accomplished a lot. Fair shake, whatever you want to say about it, the Fair Shake Political Action Committee was an extraordinarily powerful force in this last election. And that was really put together primarily by a few very powerful players in the industry, but really tried to bring people along in different ways. And so I think the industry really banded together to find a way to move a path forward, because I think 4 more years of what we had just endured was not going to be viable in any real way. And we weren't going to be able to build serious things with serious people.
I guess I'd frame it as 2 different things, the short term and the long term. And in the short term, what we've mostly accomplished is fixing problems and paying off debt created over the last handful of years. So there were some really quick wins that we saw very early on in the new administration. We saw the rollback of Operation Choke Point 2.0, right, the debanking movement. All of that just sort of wiped away. We saw SAB 121 replaced with SAB 122, so the SAB 121 rule wiped away. We saw the SEC dropping investigations and enforcement actions that took this very unreasonable, overly restrictive interpretation of the Howey test. So we saw these sort of quick and easy things that regulators were able to do that fix problems that were holding the industry back. That's great. It's all short term. The next thing that we need to do now, and by the way, we're basically out of short-term wins. I mean, maybe there's a few things left, but right now we're thinking about the long term.
Yeah.
So the question now is, how do we actually put into place durable regulatory frameworks that will survive another administration, perhaps on the other side of the aisle, that has a different perspective than this administration, or a different Congress with different leadership that has a different view from this Congress? And there's a few things that are happening. In the agency side, we have the SEC's crypto task force trying to figure out what does good rulemaking look like. I'm sure we'll see the same from the CFTC and from many other agencies, especially around how do founders create and distribute tokens with clarity that those tokens are not unregistered securities, really big issue. And then in Congress, we see 2 really major movements. One is for stablecoin legislation. I won't bore everyone with all the details. I think it's been discussed a lot already today. But there's nothing to me more obvious than that stablecoins are a better way to move dollars around the world than the traditional financial system. It's inarguable that this is an upgrade on the existing system. So that legislation should and I think will get done. And then there's market structure legislation, a much more difficult but maybe more important and impactful piece of legislation. How do we regulate the primary issuers and secondary market participants dealing with digital assets? And that's going to take a long time, but that's sort of the holy grail of what we're trying to get done.
Yeah.
Yeah, and I guess in the, Kathy, did you want to
No, I mean, I was just going to say, I mean, we still have a long way to go because, I mean, we just stopped at token issuance right now, right? And we're dealing with all of the entities or the players, the stakeholders that touch token issuance, asset issuance. So you have the issuer themselves, and then you have the exchanges and the custodians, but then you have these assets that are out there. What hasn't been touched on in any of the discussions is what happens when they're on chain. It's a whole new world, and none of the legislation really touches on what happens once assets are issued and they're on chain. I think maybe there is a supposition that they just go in and out of exchanges, and that's it. It's all for speculation. It's all for investment. But assets actually do things on chain. And I think that's another whole set of issues and conversations that we need to start having.
If I could just add one more win, I would say that from an educational standpoint, because part of our mission at DEF is to educate people about decentralized financial technology, is just the sheer amount of knowledge that has increased over time, especially in Congress and with regulators. So we had the first ever DeFi hearing in the fall where Rebecca and I testified and spoke directly to Congress about what DeFi is. I think that probably would have been unthinkable to you all a few years ago. So I think that it is a win that we're even having that conversation directly with Congress and with regulators.
Let's sort of double click on that point. I love that. I learned that like 2 years ago, and I use it sparingly. But anyways, when it comes to DeFi, right? Jake just sort of went over. We've got 2 stablecoin bills, one in the House, one in the Senate. We've got this digital infrastructure, this digital assets market structure bill that, you know, it's going to be some version of various bills that we've already seen. In light of that, though, is the DeFi conversation completely absent? Like, where is the addressing of that evergreen approach that you talked about, understanding what the software and technology, the builders and the technologists' liability is. Where is it if we don't even see this being addressed in legislation? So where are we in terms of those wins on DeFi? Is it really just at education, or is it being addressed elsewhere?
So I would just push back on that just a little bit. I think that legislation is touching on DeFi and sometimes unknowingly and recklessly. I think that market structure legislation could have the effect of making DeFi very impossible to build and exist in the United States if we're not careful. Hanging disclosure obligations or compliance obligations on technology, which is sometimes what a bill tries to do, or on software developers who have no ability to comply with those rules, would be very bad. So I would say that DeFi is part of the conversation, and we need more education so that we don't unknowingly make it impossible for DeFi to exist here. But we are getting there. I do think people are starting to understand what base layer neutrality means and what making sure that tech being a neutral tool means. So I am hopeful that there's not going to be a huge loss with market structure legislation.
So I'll ask a general question. Anyone can answer on the views. Is it better to just get the market structure bill passed, even if it potentially compromises some of the important parts of DeFi, and sort of work around it later? Or should we potentially hold back? Because there's a bit of sort of at odds, the market, any sort of market structure bill that's really focusing on centralization and regulating these entities versus really the opposite concept of a lot of DeFi applications. Should we continue to push and support something so that we've got something on the books? Or are these bills and these laws a lot harder to change in the future?
We definitely should not compromise. And I don't think we need to, because traditional financial services, which are the proper target of this regulation, are fundamentally different from DeFi in the following way. A traditional financial service is offered by a company that has some different level of power in the system than the customer. This is the justification for regulation in the first place. It's that the user has to rely upon someone else to act in a certain way in order for them to get a financial service. Someone is holding their money, someone is conducting a transaction for them who has to get best execution. In some way, the customer is reliant on the institution to act a certain way, and so we regulate that institution to ensure that it is not acting for its own benefit at the expense of the customer. In DeFi, there are no customers. There are only users. DeFi is software that anyone can use to make their own decisions about how to use their own finances on-chain. And so there is no one to regulate in DeFi. Now, granted, if you're an institution that is packaging an underlying DeFi protocol in a way that does create this imbalance in power between the institution and the customer, that certainly can and should be regulated. But that's not what we're talking about when we talk about DeFi regulation. So when Amanda says some of these bills are capturing DeFi in an inappropriate way, it is regulating software developers as if they were offering a traditional financial service, even though fundamentally they are not doing so. And what we should do is fight as much as we absolutely need to in order to make sure that doesn't happen.
Yeah,
I was just going to say, I don't think anybody on this panel would argue with that. I think we also know how to regulate centralized intermediaries. We've been doing it for years. Other countries across the world do it. And so, fine, we may need to figure out, do we give the CFTC spot authority to regulate exchanges where they're trading crypto assets, which are just commodities and not securities. But other than that, we know what to do, right? You know about conflicts of interest, you know about best execution, you know about all of those things. DeFi, yes, we have come very far, but I don't think policymakers still really understand what a front end does, right? They still think it's intermediated and controlled and custodial, and those things are not true. So I don't think you can throw one in with the other. I think we do have to really be very clear about where the line is drawn.
So the answer, it seems as though, and this is what I'm trying to tease out, naturally somebody's trying to find the intermediary, right? And so they're always trying to find the technology. And I think going back to Amanda's point, which is this is about educating where the risks really lie and that we don't necessarily always need an intermediated experience in the financial services. And actually treat it separate and apart and actually understand those risks in isolation relative to sort of the framework that is not being adopted, which is a generally intermediated model, which is really where obviously the financial services regulation is coming from. So what's the answer? Making sure that by the time we get to passing these bills, you know, we've successfully preserved the rights on the DeFi side so that these market bills, those market structure bills don't actually by default capture the technology platforms.
Yeah, I mean, we're starting to, Wormhole Foundation, we're a Cayman Foundation. We're not in the US, but it's become really important for us to go to DC, to speak with members of the Hill, to engage with regulators more. And I think it's because we want to see good, thoughtful legislation that touches the entire space. And so some of the meetings that we had a few weeks ago, it wasn't to say don't regulate DeFi. It wasn't to say you shouldn't touch messaging or infrastructure. It was, we're going to introduce ourselves. We want to tell you what is being built, who's using it, why it's being done. And so when we give you comments on why certain aspects of your bill are untenable or should not be in there, that's the position that we're coming from. And so I think, I don't, you know, you hear people talk about 121 and saying there's going to be this legislation and it's going to be so great. And I feel like the Debbie Downer in the room. I'm like, we don't need any legislation. It has to be specific, it has to be precise, and it has to allow responsible building when it can happen. And so it's the same thing everyone's saying, right? It just, we need legislation, but we don't want it to cover everything.
Yeah. Rebecca, let's go back to a good point that you made, which was, you know, we are in a post-Chevron doctrine world. Mm-hmm. And there has been, and there's intended to be more regulatory clarity. In fact, that's what the SEC and the CFTC has stated, no more regulation by enforcement, but we're actually, you know, going to give the market a heads up of what we think. What's the dynamic there? How much clarity can we expect the market to get in a world where really the regulators don't actually get as much deference as they did?
Yeah, so I'll take a step back and do a 2-second, 30,000-foot view of sort of what we're talking about from a legal perspective, which is Chevron was a case that the Supreme Court decided that basically said that regulators get deference, that their rules that were put in place are constitutional and can stand. Loper Bright was a case 6 months ago, I don't remember how long it was, last session in Congress, that rolled it back and said the regulators don't get deference, and it was really meant to curtail the expanse of the administrative state.
Last session, the Supreme Court. You said Congress by mistake.
Oh, sorry, last session of the Supreme Court. Sorry, yes. And so the question now is, if it was really intended to curtail the authority of the administrative state and the regulators, SEC, CFTC, and others fall under that, what can they really do in terms of rulemaking and what kind of authority do they have? I think that the SEC is clearly going full steam ahead in at least putting out guidance. I assume we might see rulemaking, but I don't know if we'd see that until Paul Atkins is confirmed as the chair. But I think people are going to tread pretty lightly on rulemaking in itself. We saw tons and tons of proposed rulemaking in the last administration, some of which passed, some of which didn't, some of which just got rolled back. The SEC just said that they were not going to put the exchange rule in place. The exchange rule was meant to expand what constituted an exchange under the US federal securities laws and who had to register to scope in both DeFi protocols, but also L1 and L2 validators, and said that they would have to congregate together and come in and register as an exchange together, which was obviously very untenable and not workable. So I think we will actually see rulemaking, and I think it's going to be so narrow and specific that it just may not get challenged, but I'm sure other people here have more informed or different views than I do.
And I would make a point that in a Loper Bright framework, right, the idea is that you're supposed to actually have consistency across administrations. So part part of what was being challenged is the fact that it didn't give regulatory certainty to these. It was a case about fishermen being charged fees for folks to come on to their boats, but the principle is that it doesn't give me consistency. Every time that the administration changes, the Democratic House is going to have a much broader interpretation of the rules. Republicans are going to have a much narrower application and interpretation of the rules, and we need some market consistency. So we really shouldn't be giving the regulators that much deference. And it's borne out and frankly helped the market generally. And frankly, the crypto market was actually more willing to challenge the interpretations of the SEC and the CFTC, and frankly, that'll probably continue to occur even more so now in the Loper-Bright framework.
I totally agree, and I think importantly, the downfall of Chevron doesn't mean that the agencies have less authority to do rulemaking. It just means they have to do a better job in their fact-finding and their explanation because they won't get deference that their rulemaking is reasonable. This is very different from something like the major questions doctrine or the non-delegation doctrine, which actually say the agencies have less authority. It would be pretty interesting to see a flip-flop from the political perspective, whether those who were previously opposed to those doctrines now take them up to try to limit what kind of rulemaking can be done now. We'll sort of see if that happens. But I think all it means is the agencies have to do their jobs well, which is all we really ever wanted, right? I think the industry has been painted as wanting no regulation, and that is the furthest thing from being true. We want good regulation that makes sense that we can actually comply with, and I think the downfall of Chevron will get us one step closer.
And in the 90 seconds that we have left, I did want to sort of raise the question of the states, right? In light of all of this, do we expect the states to sort of come in with guns ablaze on crypto sort of legislation and regulation, or are they going to continue to take, a back seat in maybe only a couple of states? Anybody have any reactions?
I think that states are directionally very interested in getting involved. DEF, along with 18 states, sued the SEC last year because the states were interested in getting a declaration and clarity on securities laws and how it affected their state citizens. So I think the states are interested, and especially when it comes to DAOs. I know we're running out of time. I think with DAOs in particular, states have a lot of room to decide what, if any, legal wrappers they're going to wrap around DAOs.
I think to your point, the states are trying to get involved. I think there's been something like 200 draft bills or something crazy from all of the states on crypto and how to regulate it. So I think we would like to see probably federal law so that those can be preempted, and we won't have something like 50 money transmission licenses to have to deal with in the crypto context.
Yeah, I mean, I'm always secretly, the states issue is one of the things that actually keeps me up at night because there's so many. And there is the unfortunate bit license here in New York, and there are other states who are looking to emulate that. And it's untenable, and you can't have projects dealing with federal laws and issues and then also dealing with 50 disparate states.
All right, awesome. That's a wrap. Thank you very much.
Thank you.
Thanks very much, panel. Thanks for the conversation.
All right, folks, how are we feeling? We have, I believe this is the second to last panel. BlackRock's Biddle Fund has been discussed as a major moment for on-chain finance. And in January, Apollo jumped into the tokenized private credit space by launching ACRED. Both of those are, by the way, tokenized by Securitize. As major institutions embrace tokenization, the financial landscape is shifting faster than ever. For our next panel, join Christine Moy of Apollo, Robbie Mitchnick of BlackRock, Anthony Scaramucci of Skybridge, in a discussion led by Securitize COO Michael Sonnenschein. Woo!
Hey, TradFi, let's go. Real world assets tokenization.
Okay. All right. Well, I think this is the panel that everyone's been waiting for, to hear from the asset manager's perspective.
At least these people. Thank God you guys are still here.
All right, I don't know if I made it here. I'm Michael Sonnenschein. I'm the COO at Securitize, and my esteemed panel, Christine, Anthony, and Robbie, need no introduction, and want to try and use this time as effectively as possible because these are the firms and the assets that are coming on chain that are driving tokenization. So maybe let's start with Christine. Tell us a little bit about what Apollo has been doing in the space and how you guys are thinking about it.
Sure. I'm super excited to be here, and congratulations, Securitize and Ethena. So on Converge, because I think we really are sitting at the convergence of TradFi and DeFi. So Apollo is a $750 billion asset management. We have businesses in equities, real estate, private credit, and insurance. And specifically, what we've been doing is we've most recently tokenized one of our private credit funds through Securitize. Woo woo. It is now available on 6 different permissionless blockchains. And we believe that blockchains are essentially going to be the underpinnings of financial markets infrastructure, and especially private markets infrastructure in the future.
Fantastic.
So I'll just be brief and say that we've made a lot of investments in the space of tokenization, so owning certain layer ones, and then my son and I worked with Ramon to develop Kinto, which I think most people here would know what Kinto is, which is in its sort of pre-launch phase right now. And it's basically it's an Ethereum-based chain, sort of a layer on top of Ethereum, but it captures the AML, anti-money laundering, know your customer sort of KYC elements inside the chain, which I think will be successful. And then take Larry Fink at his word that we're going to be in the world of real-world assets, stock and bond tokenization.
Fantastic. And Robbie, maybe just from the BlackRock perspective, talk to us a little bit about the thesis for bringing, treasuries, money market funds on chain.
Sure. So Robbie Mitchnick, I'm the head of digital assets at BlackRock. Great to be here with this crew. Christine, we've done a few panels together, but it's fun to do our first together. Maybe at the end we'll tell the story of how we first met. I think it's kind of an interesting one. So BlackRock.
You're going to tell the 60th birthday part of it?
No, probably not that
probably
one.
Not
yeah.
that. All right, we'll
so BlackRock has been exploring the space obviously for many years. In the early part of that, there was a heavy emphasis on kind of enterprise blockchain type applications that evolved into tokenization, but within a private blockchain context, like so many large TradFi firms did at that time. The key pivot that we made within our tokenization strategy was recognizing that public blockchains was really where the future was, and that it was time to make that leap away from private blockchain world and into a public blockchain context. And that was around the time that we started working with you all at Securitize as kind of our foundational partner in this tokenization space. So we looked at all the asset classes that potentially would make sense for tokenization. It was pretty clear that stable value yield funds with interoperability into stablecoins was the big prize that would have real product market fit. And I think we've seen that. Obviously, BITL as our flagship tokenized fund, a stable value yield fund with over $1 billion in AUM now, and continuing to grow, not just the number of clients, but a number of use cases as well.
Fantastic. So I think for a lot of folks, right, Apollo, Skybridge, BlackRock, there's tons of other asset managers out there, and they have not yet perhaps taken the leap and brought products on chain. So maybe Christine, take us through like the boardroom conversation where finally approval was given to actually bring something onto a public blockchain. What are the misconceptions? What are the roadblocks that we need to get, for more asset managers to continue launching products?
Yeah, I think it's important to note, so context for those of you who don't know, previous to joining Apollo 3 years ago, I was at JP Morgan and led and built the blockchain program there. I think what people have not really thought that is that there actually has been a lot of work done by TradFi institutions around blockchain. It's just that it actually took quite a number of years for the technology to be ready for prime time, if you will. Like, so, you know, I remember when we first started at JP Morgan, like around 2016, 17, it was kind of around the first launch of Ethereum. There certainly weren't all the layer 2s and side chains and different types of layer 1s that we have today. There was really only Bitcoin and Ethereum, right? So like, you know, let's think about where we are today. There's obviously been an evolution of many different protocols that have specialized in different areas, some around, mostly around performance. Honestly, there should be more work around privacy. And so I would say that, you know, from a TradFi perspective, a lot of work has been done to discover the use cases that will create efficiency and productivity or, you know, new alpha generation on blockchain rails. But we were just kind of waiting for the technology to be ready. And not only were we waiting for the technology to be ready, we were waiting for the regulatory environment to be open to that technology, and then also for there to be a large enough network of participants in order for us to scale some of the different use cases that we've imagined. I think where we are today is that I feel that we are kind of in like this acceleration jump-off point, if you will. So the technology is all there. As far as I can see, of course, there can be more improvement. And like I said, I think privacy is a key area that people should work on. But in addition, it seems like the United States is open for business from a blockchain-based technology infrastructure perspective, which is fantastic, which will also help accelerate the world. Although there have been, you know, regions that have been very forward-thinking, like Singapore, different parts of Europe, different parts of Asia, as an example. And then, you know, now network effects. You know, and I think this is where, you know, Securitize and BlackRock and Skybridge and others have been leading. But there have been other asset managers pioneering as well, like Franklin Templeton, Wisdom Tree, KKR, Hamilton Lane. You know, I think that every first step is the hardest. But at some point, you know, the risk factors of being a fast follower to all of us on stage, plus all the ones that I've mentioned, you know, has become like the threshold has become much lower. And then soon it actually just like flips into like, why are you not on chain? Like, what is it that they're doing? Like, you know, especially if we start demonstrating use cases that create value, that generate and create AUM, like then you'll see a real acceleration of everyone being like FOMOing in. So, you know, I think that right now is the time. We're going to start seeing it.
Gentlemen, thoughts on that?
Well, obviously, I agree with Christine, but I guess I'll just center my thoughts on the policy for a second.
Sure.
I think that the real hope now is that elections do matter. And again, whether you like Donald Trump, dislike Donald Trump.
Tell us what you think.
Well, I think people know how I think.
I'm just kidding.
But I would just say that the policies matter. And I would applaud the people that are working for him in getting the policies right. And I think what's happened to this industry, we had sort of left thinking and right thinking as opposed to right or wrong thinking. And, you know, listen, the Democrats better get religion, because if they don't get religion, they'll be assaulted again in 2026. Over $250 million was spent in the last election. And you guys have to understand this. To remove an incumbent like Sherrod Brown is a monumental task. I mean, look at some of these dinosaurs in the Senate, right? I mean, you know, I don't know, Chuck Grassley's like 600 years old. I think he's like George Washington's grandfather. He's been in the Senate forever. And it's impossible to move these people. But the crypto fair shake, combined with other people, knocked Sherrod Brown, who was the chairman of the Senate Banking Committee, out of the box. And so I just want to say I agree with everything Christine's saying, but the Democrats better get on side on these issues as it relates to the adoption of these technologies in this country.
All right, Robbie, let's shift gears and talk a little bit about BUIDL. Obviously, at Securitize, we have a tremendous conviction in tokenized treasuries. Treasuries are what make capital markets go around: collateral, trading, lending, borrowing, et cetera. So when you think about BUIDL and its use cases, For an audience today that's thinking about tokenization, is it democratizing access? Is it liquidity? Like what are the things that you think are really driving BUIDL's adoption?
Well, fundamentally, it represents a pretty significant breakthrough versus what the status quo was, right? And I think that's kind of an instructive lesson for tokenization generally, is it's not enough to just have nice adjectives like, liquidity and transparency and digital. You have to actually have a pretty good understanding of what the problem that's being solved is. And in this case, it was that you had to, historically, make a trade-off between yield and liquidity, right? If you wanted yield, that meant a bank account or a traditional money market fund that was paying high yield. And if you wanted liquidity, that was a stablecoin, really, right? And but if you did stablecoin, then you were foregoing significant yield. And by taking a tokenized stable value fund and making it effectively interoperable and having it run on digital asset rails, you break that trade-off. And you allow for this paradigm of being able to save in US dollars in digital form and also be able to be instantaneously liquid. And that's really the value prop that's been unlocked so far. But we're just kind of scratching the surface of all the client types and all the use cases that you can pursue around that. And certainly having the regulatory clarity is going to help, because a lot of these things don't fall neatly into one existing parameter or other.
Agreed. Christine, on ACRED, we are bringing private credit on chain. Private credit's obviously been a very hot topic, a very hot area of investment on Wall Street. When you think about all the things that Apollo does, why was private credit kind of the first project to be on a public blockchain?
Yeah, sure. So, at Apollo, our $750 billion that we manage, $500 billion of that is private credit. So, we've been pioneering in private credit for a number of years, and, it's like a key capability of ours. I think private credit has recently been in the public domain more because of the rates environment and obviously people's interests in the excess spread per unit of risk that asset managers like Apollo can generate. So, just to kind of outline the differentiators for how Apollo does private credit. The first thing is, we are specifically focused on purchase price matters, right? So this is basically one of our key mantras, regardless of what the market environment is, purchase price always matters. And that leads us to be able to generate excess spread per unit of risk, which is basically how do we generate alpha for our investors, whether they are retirees and sovereign wealth funds, or in this case, crypto native investors, to have a significant excess spread over what you can get in the public markets. And then the third differentiator for Apollo Private Credit is that we are totally aligned. So whatever we originate and put into the funds that we distribute, we also invest in directly ourselves through our insurance balance sheet, and as well as our Apollo balance sheet as well. So obviously can't guarantee returns, but what we can guarantee is that we're going to experience the same performance as you are, and we like to generate alpha, of course. And so overall, there's been private credit has grown very quickly because, especially from the likes of the institutional investors like sovereign wealth funds and pension funds, et cetera, have been allocating to this, but it's had always been limited to those domains. And so one of the key focus areas and missions of Apollo, and then me personally, is how do we expand, broaden access to this alpha generation to broader investors like you, without you having to be a sovereign wealth fund, or without you having to have a private banking account with one of the top tier TradFi firms. And so blockchain-based distribution is one of the key parts of that.
Do you
Go for it.
envision a future where this is taken out of the domain of the traditional banking origination, where this could literally be done on chain and people from all walks of life can put their money into certain assets, they get deployed into private credit without the traditional system.
Yeah, I mean, I have
sort
a
of bypassing the banks.
I have a particular, I'm not going to talk about bypassing the banks because obviously you know my heritage, but I can share with you the vision that I'm working towards, which is, okay, let's talk about how, like today, when I get paid by Apollo, I get a deposit into, my bank account. And, on any given month, I might check my account and say, okay, my credit card bill is going to be this much. I have this much left to, invest. Usually a hot mess and working too much. So I'm like, maybe I'll just put it in treasuries and get whatever the treasury yield is, if at that. And it's like a multi-step process and need to go press some buttons and call someone to confirm it. And then inevitably the next month I have to pay taxes and then I have to unwind out of that and like put it back into cash and then like wait until like my check clears. Now in a future world, and this is what I'm working towards and building with each of you, is I get paid into my crypto wallet, and in my crypto wallet I have almost like a model portfolio designed that's customized to me. It's going to be 10% stablecoins. It's going to be 20% BUIDL, money market funds. It's going to be 25% Apollo private credit, and like 25% Ethena, right?
Give me your pen, Robbie. I got to write this down.
Right. But like, imagine like I have like basically like a customized portfolio to my risk profile that says Christine at all times wants to have her account in this pie chart.
Yeah,
right?
and there's a smart contract that when the assets drop, it deploys.
It deploys automatically. And then what that means is that every last penny of my earnings is fully invested in yielding without me actually having to do anything. And then, if I'm having Nobu at lunch and basically I use my Securitize debit card that's connected to my Securitize wallet, basically like, okay, here's like $100 to Nobu, that's an automatic swap of $100 out of my BUIDL into US dollars, into USDC, off-ramped, like CU zero hash, off-ramp to pay Nobu. And then essentially, like, that means not only is every penny of my earnings deployed, it's deployed up until the last second of which I actually spend it. Now, isn't that a 10x experience than what we have today? I don't know if all you are managing your earnings better than me.
It's a great explanation.
But that is absolutely a 10x experience, and all of that exists today. Stablecoins, treasuries, Apollo private credit, plus like, your crypto native yield, debit cards connected to crypto wallets, like, this exists today. And so the way that I see this happening is that all of the people here as like the crypto pioneers that will like help build this product. We'll use it for our own, earnings and treasuries. And then once like the normies realize this is way better, that's when, things will sort of move on to chain. It's just that we haven't yet gotten to the 10x experience to shift the inertia from like your current state to the future state, but we are totally there.
It's a great explanation. So one more question. Do you
Go.
mind?
Thanks for teeing me up.
All right, so you're a banking CEO, and you just heard this great explanation from Christine. How do you prevent your bank from getting bypassed by some of the things that she's talking about in terms of products?
You have to provide that because they have the incumbency advantage to do that, right? They have the customers, they have the interface, they have all the interconnectivity, so it's a matter of being proactive in,
But that's
in migrating.
what she just described is fairly costless.
Well, it sounds like from what Christine just said, if we can move to that kind of utopian way of kind of investing almost, it means no more like hand-to-hand combat of massive sales forces of humans running around trying to collect commission checks and private banks and things like that. And it means much more democratization of products and investors finding each other out in the interwebs, right? Which is very different than the way that traditionally that products are sold. And I think that's a big part of what we're trying to do with tokenization because, to your point, Christine, there are only so many sovereign wealth funds and only so many family offices and so many whatevers that are out there to buy these products. And if access is typically restricted, then it is actually allowing access to a much larger swatch of the investor community to be able to access these products on chain.
Yeah, and because blockchain-based assets and smart contract transactioning is pretty seamless and now close to costless, it doesn't matter if your bank account, if you will, or your investment account is $100 or $100,000 or $100 million. you can scale up and scale down that, like with that solution.
So I'd say, Christine, when you said everything that you described exists today, I would agree almost.
Okay,
right?
tell me.
With the exception being, you don't actually yet have the full building blocks of a whole portfolio in tokenized format, right? We're starting to get there.
I don't think you need anything else besides BUIDL and ACRED.
Well, wait,
to be
this was
honest.
actually going to be one of my next questions, right? Like, if we're having this conversation, because we only have a few minutes left, I want to look forward a little bit. If we're having this conversation a year from now at the next Tokenize, today we're talking about tokenized treasuries, we're talking about tokenized private credit. What else are we going to be talking about? What else is going to have been tokenized? And
I think
how
this
much,
is where Robbie was going to
yeah, like how much more is this going to complement the portfolio Christine was talking about?
So I think the key insight from the industry's experience the last however many years has been it is much easier to offer digital asset products where people are already using digital assets in some form, right? And so if all you did was say, we're going to tokenize mutual funds, like existing clients come running to use the new tokenized version of the mutual fund, abandon all the infrastructure and processes you're used to, trust us, this one's better. Like that unequivocally does not work, has not worked, right? It's how do we start to one layer after another. First it was crypto, stable coins, tokenized yield funds, now tokenized credit. And all of a sudden you have people by the hundreds of millions, of course, who are using digital assets in some form or another. You can start to add to what's available, and eventually you'll end up with the whole portfolio. And obviously that's a big part of your guys' strategic thesis is to be, you know, at the core of that infrastructure that enables that tokenization to come to life in a broad-based way.
Absolutely.
Not to bring it back to politics, but
bring it back to politics.
1 second. If you get positive definition on stablecoin legislation, tokenization, clear lines of regulation so that there's no more regulation by enforcement, and you can free up resources. Think of the legal resources as an example, or CEO, CIO, general counsel time deployment into fighting the SEC over the last 4 years. And so if you can just get this right, which I predict will happen over the next 12 to 14 months, because again, I don't think these members of Congress want to go into 26 saying that they're not on side with this. And so I think the combination of what you guys are talking about, intersecting with the right legislation, is reason enough prima facie to be bullish about the industry and the products that are going to come out of this industry.
So if we stick with this thread, this future state, Christine's portfolio, check lands, et cetera.
Christine, I'm ready to sign up for
yeah,
the portfolio.
seriously.
I just want you to know.
A lot of
I want it on my phone.
ACRED subscription forms.
A lot of people are going to get disintermediated by a lot of these types of changes by tokenization, right? Today, some of that is driven by regulation and compliance, that there are certain hurdles and certain stops along the way. Some of that is for record keeping. People take fees along the way. Some of it is time-based in order for systems to settle and reconcile and whatnot. So as you each, kind of think about the future of tokenization, which of these areas do you think are probably changing the fastest when you think about how this is evolving?
It's interesting. I think disruption doesn't actually mean like the legacy systems get canceled and then you have like a full switch into the other side. I mean, there's still postal mail, right? Like there's still like, kind of, I don't know, someone's using a DVD player somewhere, right? I'm sure my parents are. I think what it is that the energy and the heat and the innovation and the growth move into the new spaces. So I think that potentially happens naturally. As we know, this next generation of investors that are now starting to join the workforce and expand their earnings are crypto native. Their first investment is probably Bitcoin, probably some ugly monkey picture, and a ton of altcoins, right? So they don't have like preconceived notions of what format, what technology, who the purveyor of investments should be. And in fact, they might even have more of a bias towards something that's crypto native. And so over time, as they join the working world and inherit generational wealth in addition to creating their own, their investments will be blockchain based. And I think part of my job as well at Apollo is to make sure that we are meeting that next generation of investor. I think we see that next generation of investor is, over time they will have to start thinking about saving for retirement, and we want to be there for them. But right now, they seem to have more of an interest in getting active with their investments. I think we see this with, especially around DeFi, meme coins, and then previous to that, some of the stonks, right? In the equity markets. So, I think that this generation's expectations of what investments look like and how they want to interact with their investments will be different than this current generation that we are all accustomed to. And so I think, the conversion will be gradual, and it will not be as recognizable as turn all this old stuff off and put it on new stuff. It's just that there's going to be more flow into the new stuff, and that's going to be fun and exciting, but there will still be existing infrastructure and AUM in the existing legacies systems.
Okay, one other topic as the clock is running down here. I want to talk about DeFi. So one of the things that I think we wake up with every day and carry with us every day at Securitize as we're bringing assets on chain is we feel a burden to objectively not just tokenize things for the sake of tokenizing them, but because ultimately we're going to be offering investors the potential for a higher return, potentially a better user experience, more frequency of dividends. There has to be some greater utility or some element of what they're doing in a tokenized format that objectively outweighs their real world or traditional counterpart. And I think a lot of our focus and a lot of what we're seeing across the industry is connecting RWAs to the world of DeFi. And for many institutions, when you start talking about DeFi, they start to get a little bit skittish, because how is it that they know what pools these assets are going into, who's in there, who's lending, who's borrowing, et cetera. So how do you guys see that market evolving? What do you see the roadblocks are? Maybe even from a regulatory perspective, what kind of clarity or things should we as an industry be lobbying for to get better connectivity from RWAs into that ecosystem?
You got it.
Don't everyone jump in at once.
It's a hard question.
I guess what I would say is there's a comfort sale that has to happen. So you've got to get institutions comfortable. You've got to also get CEOs of companies comfortable, bank CEOs in particular. But I think the sale has to be, the narrative has to go something like this. The entire landscape can change for your company if we go in this direction. And there'll be massive cost savings. And I'll just give one weird use case example, then flip it over to Rob. And this would be my sale if I was an investment banker or someone at Securitize trying to sell the concept. If you're at Starbucks or Walt Disney, you want your stock tokenized, and you want that in my wallet on my iPhone. So when I go to the park, if you're in a share repurchase situation, you can buy the stock on my phone right at the point of entry to the park, or I can sell my shares to the Starbucks barista for my coffee. Maybe you're offering a discount to do that. And I'm just giving 2 examples of applications that can be used if we go in this direction that could help even customer loyalty for those companies and even Apple Computer. Flip it over to Rob because I know we're running out of time, but we're just saying you have to get people comfortable that their world is going to be made better by doing this.
I agree with that, and I think maybe further afield in the domain of DeFi, the biggest hurdle is identity, right? And so being able to get comfortable for institutions that they can fulfill all their AML, KYC requirements while interacting in the DeFi space is sort of fundamental. That hasn't quite been solved yet, but I think there's a lot of pretty promising momentum around that happening that it's probably measured in a small single-digit number of years before that's really unlocked.
Christine?
I'm a big fan of DeFi. I think that DeFi is essentially like, turning financial services into tech microservices, and will probably be, what powers the back ends of most financial institutions' investments in the future. I agree that there are some challenges today that need to be worked through, but I think that the prize is significant and it's worth working on. And as Robbie said, I don't think it's something that will be an obstacle for very long.
Fantastic. Well, we are going to leave it there. Thank you, Christine, Anthony, Robbie. Appreciate your guys' time. Thank you, everybody.
All right, who's ready to talk some regulation, huh? As we wrap up today's event, don't miss our final session where Securitize's Brett Redfern and Richard Gabbert speaking publicly for the first time since being appointed Chief of Staff for the SEC's Crypto Task Force. They're going to dive into the future of crypto regulation, exploring the SEC's Crypto Task Force and the policy path forward in the era of Trump 2.0. Let's give it up for Brett and Richard.
I'm going to move this over a little. Hello, everybody. Good afternoon. Thank you for hanging in there. Last session of the afternoon before drinks, so we'll try to keep it as lively as possible. My name is Brett Redfern. I am the founder of Panorama Financial Markets Advisory. I am an advisor to Securitize. I've helped them with a number of the things that they've done. I guess one of the reasons why is I spent 3.5 years at the SEC running the Division of Trading and Markets when Jay Clayton was there. And so there's a lot of things to work out there. And I'm very pleased today to be able to introduce Richard Gabbert. Richard is, all of the conversations that we've had so far about policy and regulation, keep in mind that any of the issues that pertain to securities go to the SEC. So we've talked about the Hill, we've talked about legislation. The reality is, if it's in the securities framework, there's a lot of things that can happen at the SEC today, and that's partially what we really want to dive through. So when we think about policy under Trump 2.0, a lot of that is getting focused at the SEC's Crypto Task Force, and Richard is the Chief of Staff of the SEC's Crypto Task Force. Just a couple words about Richard. He worked before that, before moving there when, like a month ago or two or something?
2 months ago almost.
2 months ago. Before that, he worked for Commissioner Hester Peirce, Crypto Mom. We all love Hester because of all the things that she's done for the industry, but he worked for 7 years, was it?
7 years, yeah.
7 years, and before that, he actually worked in the Division of Trading and Markets when I was running the Division of Trading and Markets. I think we worked together for about 2 or 3 months or something before she recognized his talents and he pulled her up. So anyway, we're very excited to talk about a lot of these things, about what is the SEC doing, what is this Crypto Task Force, we got roundtables, a lot of how the SEC engages with the Hill and, and the Crypto Council and so on. Right. So let's dive in. Richard, I think you have a little disclaimer you got to start with, right?
Thank you, Brett. Yeah, I do have a disclaimer. The opinions I express today are my own and not those of the commission, my fellow commissioners, nor my colleagues. So having said that, fire away.
I used to have to do that all the time and would try to end with, and if you don't like them, they're not mine either. Anyway, so let's talk about the Crypto Task Force, Richard. So we've all seen this. We know that Commissioner Peirce has put out, now kind of like a request for information. I love it. She cites, Bob Dylan. Some people would say Jimi Hendrix, but Bob Dylan. There must be some way out of here. Throws out 40-something questions where she's waiting for all of you, by the way, to answer those questions, write them up and send them back in. But it's great. So tell us about the crypto task force. Like, what is the objective, and how is this going to work?
So yeah, under Acting Chairman Ueda, the commission is kind of stepping back, right, from its enforcement first approach that has characterized the commission for the last several years in its approach to crypto. And one of the flaws of that approach is that it really emphasized a retroactive and a reactive approach to crypto regulation. And the goal instead of the crypto task force is to help set the commission on a better path, right? More clarity, more certainty for market participants, more communication with market participants as well. And so the task force draws largely from staff within the commission, across the commission, from several different divisions and offices, folks who have deep expertise in our markets, in the statutory framework that we operate under, and in our rule book. We've also brought a couple of people from the outside, Landon Zinda from Coin Center, and Mike Seelig, who was most recently at Wilkie Farr. And so what the task force is trying to do is coordinate across the commission. You know from your time there that the various divisions and offices can get rather siloed. And our hope is to kind of overcome that siloing effect and actually promote cross-pollination, right? There are a lot of issues that span divisions or offices. We want to make sure that people inside the building are talking to each other and that we're able to generate ideas that actually represent solutions for folks in the industry. And another thing that we hope to be able to do is to set an example for how the commission can engage with the public. We've heard repeatedly over the last 4 years that the commission staff had stopped talking to people. And we want to try to make a change in that culture. There are a lot of folks at the commission who have a lot to offer, who are good lawyers and good analysts who can think carefully about solutions to problems, and we want to empower them to engage with folks in the industry.
I remember there was a period of time when people would want to go down there and they thought that if they went in and met that they might get followed up with a Wells notice, and so they sort of stopped going there.
Right.
But one question I have is this. So this, quite frankly, the speech on there must be some kind of way out of here. 48 questions, I think it was.
Yeah.
Very thoughtful questions, organized. Like, how did you come up with those questions, and to what extent does that kind of reflect the real policy the priorities that you're thinking about?
Yeah, the range of the questions really does, I think, reflect the breadth and depth of expertise that we have at the commission. And frankly, expertise that was largely left to languish when it came to addressing the needs of this market over the past several years. We worked closely with the staff in the divisions. We had brainstorming sessions with members of the task force, a lot of conversations with Commissioner Peirce, and tried to identify kind of the key issues that probably need to be tackled early on, right, to provide some clarity for the industry. The goal was, there are 48 questions, and that's not counting the sub-questions, right, that some of the questions had. The goal was not to overwhelm the industry. It really was to try to identify specific issues that we've been puzzling over and encourage folks to respond from their own experiences in their own area of expertise. I'm sure there will be some folks out there who want to answer all 48 plus questions, but you shouldn't feel compelled to do so, right? Answer those where you think you can add value. I checked this morning, I think we've gotten 22 written responses so far, some of them very detailed. We've got one 30-some page submission that addresses only questions 1 through 6 of the RFIs. So I look forward to the multi-volume set that we'll eventually have on hand.
So for this crowd, I'm sure there's a lot of people who would like to influence the policy formation process in some way. If folks out here are thinking, I really want to get down there and get in front of that task force and, and share my views, what is the best process for them to go through to potentially get involved?
Right. So if you go to the Commission's website, there's a link on the front page that says Crypto Task Force. And if you click on that link, at the top of the next page, there are two buttons, one for written input and one for a meeting request. And if you would like to come in, click on the meeting request form, fill it out. We do ask for an agenda and materials, if you have them, to accompany your request. Any materials for which you've not requested confidential treatment will be posted to our website along with the agenda. And that is just to ensure that we are being as transparent as possible and to provoke dialogue, not only between industry and the task force, but also in the industry and with other interested parties in the public about the conversations that they're having with the task force. With written input, the procedure is very similar. Materials that you submit will be posted to a different section of the website, and we are reviewing those, and they will also contribute to public discourse. In addition, I think we'll be getting to roundtables shortly. If you have ideas about possible roundtables or suggestions for people to participate on those roundtables, you can also send those suggestions to crypto@sec.gov.
So the roundtable idea is great. So many of you have seen this. They've now posted there'll be a series of roundtables at the SEC. The first one is scheduled for March 21st, which is on defining security status.
Right.
I know that when I was there, we held roundtables, and they were great because when you get one-on-one meetings, you hear like one side, but when you get everybody in on a panel discussion, they really kind of argue it out, and you get a lot of great stuff on the record. So is it the same kind of idea? Like, what is the objective of the roundtable, and what do you expect to come out of that?
No, it really is to foment public discussion on difficult issues. We're bringing in, I think, for the first roundtable, and I expect the pattern will follow for subsequent roundtables, 12 people from a wide, diverse range of backgrounds, including a few folks who are skeptics of the industry. And it really is to get people talking about the issues in depth in a way that will inform the task forces and then eventually the staffs and the commission's thinking about each of these issues.
And these will all be webcasts. So people can stream it and watch everything that's going on. They don't all have to go to Washington.
No, you don't have to come to Washington, although we'll have cherry blossoms in the very near future. So it's
a lovely time
to visit.
The lovely time to visit the city. And so we don't know what the next topic is going to be. Are they going to be like monthly or like?
I hope that they'll happen in pretty rapid succession throughout the spring. I expect more details to be forthcoming maybe as early as this week.
Fantastic. So another thing that we've all, of course, been paying attention to is the White House Crypto Council. And we've seen this established at the administration level. We know that, it was March 7th. There was the White House Digital Asset Summit, with David Sachs and the president and like a very impressive group of industry CEOs all gathered around. But the question I have is, so at the SEC, you're doing your thing, and the White House has the Crypto Council.
Right.
How are you, and I know Commissioner Peirce was there, right? But how are you kind of working out what the SEC is doing relative to the White House and their efforts?
Right. Well, the president, made a promise during the campaign, right, to the American people that the U.S. would be kind of the crypto capital of the world. And so it's clear that if that is to be the case, the Commission has a significant role to play. Market participants, as I said earlier, right, they want clarity and certainty. We had a lot of confusion over the past several years. And, this has helped to create a dysfunctional marketplace. We are certainly, going to be paying close attention to what the White House is doing here. I think the White House, right, is coordinating kind of a government-wide effort, because this technology is not just about finance. It's not just about assets, right? It has broader societal and governmental implications. So we'll be, working to, provide relief where we can expeditiously, and to, take the initiative on issues relating to securities and hopefully providing guidance as to what is not securities. And as we do that, we'll coordinate with the White House and make sure that we're working to achieve what the administration has set as the goal, which is to reshore folks who'd moved offshore over the past 4 years, and to facilitate the creation of a regulatory environment that is hospitable to innovation.
So one thing that is different that I can note from when I was there is this executive order now that has come out, where basically policies or actions of the commission have to be run by the White House or run by OMB before they go forward. That's a little bit different. So that's kind of the executive branch having a little bit more input over the policy. How do you look at that? Is it that anything that you decide to do that's meaningful has to go back to OMB to run it up the flagpole, or?
Yeah, I think we're still working through this. My understanding is that actions that are voted on by the commission likely will need to go before OMB. Although don't quote me on that, I don't know that for sure. But I think that, we already do send all commission actions to OMB for review of the Paperwork Reduction Act portion of the rulemaking. So the process is not entirely foreign to us. What this does, I think, is subjects our economic analysis to a second tier of oversight. And, I don't think that that's necessarily a bad thing. Hopefully it will make our work more rigorous, more data-driven. And I do think that, given that bringing clarity to this marketplace is one of the goals of the administration, I don't expect it to interfere with our ability to take action in this space.
Interesting. So Congress, we're in a great time, right? We have, Chair Scott of Senate Banking Committee. We have French Hill from the House Financial Services Committee. All of these. There's prioritization on stablecoins, a market structure bill, legislation generally. It's pretty exciting, but now, so there's this issue of what is Congress doing and what is the SEC doing? I think that in areas where there's sort of clear statutory authority related to securities, it's sort of game on, you guys can run with the ball.
Right.
When it's gray area things, there's going to be other areas who need statutory authority. I think during the Gensler area, there was not a lot of constructive dialogue between the commission and Congress. It's called technical advice. Like, they give you bills, you read them, you try to give them feedback. How do you see that having changed, and do you feel like there's going to be great engagement between commission staff and Congress in terms of some of the legislation that will be pertinent to these policies?
Right, yeah. No, I mean, Congress, has the authority to establish the statutory framework under which agencies like mine operate. And so I think it is incumbent on us to provide technical assistance where we can. And under Acting Chairman Ueda, that is the stance, I believe, that the agency is going to take, to engage with Congress on these issues. And this is a helpful avenue for dialogue as well between the Hill and between the agencies, right? Some of the details of our regulatory framework are not always obvious to folks outside the building. And so the technical assistance process allows us to provide insight on the interaction between, proposed legislation and the existing statutory framework or our rule book as well. And yes, we do have authority to regulate securities. Commissioner Peirce has expressed her view for many years now that the prior chair of the SEC, had adopted an overexpansive view of what was a security, right? I think he many times said that basically the entire tokens throughout the digital asset space are overwhelmingly or almost entirely securities, and Commissioner Peirce has taken a different view. And so there may be areas where the commission provides clarity, as it did recently on the meme coin, with the meme coin statement. Actually, that wasn't the commission, that was the CorpFin staff, but provide clarity that certain things are not securities. But certainly what remains in our remit, we do have the authority to regulate.
And that's actually fantastic. So another question that is of great interest is the SEC dynamic with the CFTC, right? So, we have an interesting history where you have jurisdictional questions about what goes within the mandate of the CFTC, what are commodities, what goes in the mandate of the SEC. Certainly Congress is going to have to speak to some of these, but in the meantime, there's a lot of behind-the-scenes stuff that you're working out between the SEC and the CFTC. I think one of the things, so Richard and I actually worked when he was in Commissioner Peirce's office on Title VII implementation, right? So you have security-based swaps, and we had a memorandum of understanding. We would sit down with the CFTC. We'd try to figure out things because they really affected both sides. That was an example of a success. There were other examples where we didn't necessarily see eye to eye, and there was quite a bit of friction. So how are you seeing that sort of dynamic? I think under Chair Gensler's thing, there wasn't a lot of good conversations happening back and forth. How are you seeing that changing and working moving forward?
Well, President Trump's nominee for chairman of the CFTC is Brian Quintenz, and he was Commissioner Peirce's counterpart when we were working on the Title VII issues back so long ago, right? And I think we had a pretty good working relationship, wouldn't you say?
I think it was great. So I will tell you this, when I got there and I could not believe they had this meeting, Chris Giancarlo was the chair at the time, and he and Jay Clayton had this whole big thing, and we got all the SEC staff together with the CFTC staff, and we were like, this is great. I was actually surprised. I didn't think this was gonna happen when I got there. And they ended up taking a picture of the whole group. They put it on Twitter, and all of the commissioners that weren't invited complained.
Right.
Because it was like a couple of commissioners, so they're like, I don't know if we can do that again, right? But that was he was a very that really helped a lot, that relation. So this is great that he's
right. So I think that'll be really beneficial in terms of our two agencies working together. Now, I'm not an expert on the CFTC's jurisdiction. I do think there's a question of what authority they currently have. I think, the FIT 21 bill, maybe some of the other legislation that's being considered by Congress would give the CFTC expressly authority over spot market in digital assets that are not securities. We'll have to, see what that legislation looks like if it's enacted. I would say, my one big hope is that if we do go that route, that it is easy to distinguish between what is a security and what is not. Because I think, another of the examples we lived through during your tenure was the unfortunate, what was it, the spikes?
The spikes.
Product.
I have to tell this anecdote very quickly.
Yes,
so there was a product called the Spikes, and the question was, is it a security future or is it a future?
Right.
And the CFTC had told, this was the Miami Stock Exchange, that it was definitely a future and not a security future. And my staff at the SEC, it's definitely a security future, no doubt. The starting meeting was, we are 100% sure it's a security future. Nope, we are 100% sure it's a future. That's where we started. And after 2 years of back and forth, we never got on the same page on that.
Right.
So.
Right, and I think
it is not always aligning the way you would like it to.
Right, and this industry innovates even more rapidly, right, than the traditional financial markets. And so I think if we get stuck in that loop, that's probably not productive. So hopefully we find some way to make that division a little clearer.
Hopefully Congress can help, right?
Yes.
But it is true, as to Richard's earlier point, right? The CFTC does not oversee spot markets, nor does it oversee retail investors. It is professional markets, and it's not spot products, it's futures, commodities, and so on. So they really do need legislation to do that. They really don't necessarily have the the full bench to regulate that. So it's going to be interesting to see how all that. Be nice if they could merge them, but we all know that, you know, that merger thing, the Agriculture Committee and others, they don't really love that idea so much.
Yeah, well, I won't speak to that.
Yeah,
but I will.
Good idea.
I will say, right, we do have plenty of experience in the dual regulation of entities in the traditional market space, right? So there are broker-dealers that are also futures commission merchants. There are swap execution facilities that are also security-based swap execution facilities. And so, you know, I think it is possible to find a workable way forward there. And that may, you know, to the extent that we have dually registered trading platforms or broker-dealer type entities, that may take some of the pressure off of distinguishing between what is a security and what is not a security. But that will require a great deal of coordination during the rulemaking process once this legislation is.
I did love the comment made earlier about it would be nice if everything could just be on one screen, right? But you think about like two regulators and two different, like, you know, like one screen would be fantastic. But
right,
we'll
well,
see.
We'll see
see
what
how
Congress decides.
So I want to talk about enforcement. I think everybody's pretty pleased that a number of these cases were effectively dropped. I don't know what the right terminology. I heard earlier dismissed. I'm not sure they were dismissed, but they were effectively dropped. The commission came back and they said, we're not sure if we even agree with the last brief that we submitted to the court. So we're gonna back away from a lot of these, which is helpful. I would ask the question this way. So I love reading Matt Levine from Bloomberg, and he wrote recently, in the Trump administration, the legal status of crypto is still uncertain, but the enforcement status is go ahead, do whatever. So now I have to believe that in the commission, it's probably not go ahead and do whatever.
Well, I was going to say it's a good thing that Matt Levine in many of his columns says that he is not providing legal advice.
That is, he typically does say that.
Yes, he does.
That is in fact
so don't take that as legal advice,
not
is
legal.
what I would say.
So how should we, right? So I think Commissioner Peirce and maybe Ueda as well have come out and said we're really going to be focusing on fraud and manipulation, you know. But I think that there's some question about, you know, some folks might think, hey, it's game on, like, you know, like how should we be thinking about the enforcement posture in light of the changes to the enforcement, you know, vibe altogether?
So I certainly can't speak about any specific enforcement matter, and you haven't asked me, but just to put that out there. And I probably shouldn't say too much about the enforcement program more generally, but I will say, right, you're correct. Commissioner Peirce has said that, you know, we are going to continue to our unabated pursuit of fraud in securities transactions. So to the extent that, you know, there are tokens out there that are securities and there's fraud in them, you can expect the commission, you know, to continue going after the folks engaged in that activity. And, you know, in the Coinbase dismissal and the press release that the commission issued on that, right, it said that, you know, this decision was made, you know, to allow the commission to exercise, let me actually read from it here. So this decision to exercise its discretion and dismiss this pending enforcement action rests on its judgment that the dismissal will facilitate the commission's ongoing efforts to reform and renew its regulatory approach to the crypto industry. So I think that's a useful summary of where the commission is at this point.
Very helpful. So timing. So, you know, I will say this, that, you know, there's this sort of, in the last panels, we've heard some interesting discussions, and some of it has included, well, we think there should be regulation, but not everything should be regulated. And then there's sort of like, we want clarity, but sometimes clarity, it's good. I don't think everybody's necessarily going to love everything they get when they actually put rules together that then you have to abide by. And so ultimately, it is a process. You've got the task force, you've got the roundtables, you've got a ton of comments coming in, you potentially have rulemaking, you got to check in with the White House. So when we think about the timing of this, right? And by the way, not to mention the fact that I think everybody knows, like, there's a massive downsizing going on right now. I don't know, maybe that's an overstatement, but a lot of people are leaving. They're taking the Doge retirement package of 50 grand if I leave, you know, I don't know when it was. But a lot of people are leaving, and the responsibilities of the commission are increasing substantially, right? And by the way, equities, options, fixed income, all the other things that they regulate are not going away. So in that environment, how do we think about how long is it going to take to kind of crunch through this process and really turn out some of the policy that kind of provides that clarity and unlocks the opportunities here?
No, I mean, you're right. There are a lot of talented staff at the agency who are, probably going to take one of these offers and leave, they will be missed. Fortunately, we have a deep bench at the agency with, I think, a lot of other talented staff who will be ready to step up and do the work that's necessary, right? Whether that's in the form of, no action letters or staff guidance or interpretive releases or FAQs or, writing proposed rules for commission consideration. So I'm confident that we'll, continue to be able to move ahead with respect to these issues. And, we've done quite a bit already. On day 2 or 3 of the new administration, we rescinded, or the staff rescinded SAB 121, right, which had caused so much grief in the industry. We've got this very detailed set of RFIs out that are already provoking a great deal of discussion and conversation. Staff statement from the Division of Corporation Finance on meme coins. Acting Chairman Ueda last week suggested that he had asked the staff to revisit, right, the proposed rule that, among other things, would have revised the definition of exchange. And then we have these roundtables coming up. So I do think and hope that we'll continue to move at a rapid clip in the coming months.
Listen, I got to say this, the pace that you've been moving has been great. All of the things that you just mentioned have happened fast, and especially compared to the 4 years prior, really impressive amount of accomplishment so far. A lot of work being done. I just want to thank you for the work you're doing and thank the commission for this next phase. And we're going to try to end like 20 seconds early, so because we know everybody's getting drinks. So let's thank Richard for joining us.
Thank you, Brett.
All right.
Appreciate it. Thanks.
All right, folks, we hanging out for a little bit? Just kidding. It's absolutely insane that out of all the distinguished guests today, I'm the one that gets the last word, but that's kind of what tokenization is all about, right? Democratizing access. I'll keep these closing remarks short and sweet. Thank you to the Time Center for hosting us today, including all of our incredible crew who's been here all weekend long. Let's give it up for our crew. Thank you to all of our panelists who graced this couch today. We really are very grateful for that. Thank you for all of our sponsors as well who put this together so we could organize such a thoughtful agenda. The entire Securitize and Wormhole teams are truly grateful for everyone's time and commitment, not just today, but day in and day out to build such a strong foundation for the tokenized economy. This is going to be the first of what we hope is many tokenized events, and we're thankful that you could all be here today for the first. With that, folks, though, it is 5 o'clock after on St. Patrick's Day, and I am a Murphy after all, so let's kick off this happy hour, which is sponsored by ZK Sync. It's downstairs, so make sure you head downstairs for it. We encourage you to take what you've heard, exchange ideas, and continue the conversation with everybody that came out today. Thank you all so much.